There is one potential black swan out there that I see that I don't think it's a near term risk. It's probably not a medium term risk. I do think that among insurers, there are a lot of problems. I think there's a
Mm.
systemic problem among insurers.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Stocks entered the year trading at or near all-time record high valuation extremes. So when stocks look richly valued like this, short-term sellers take notice. Is it time to start shorting the market here? To find out, today we've got the good fortune of welcoming back to the program one of the best known short sellers in the business, Carson Block, founder of Muddy Waters Research. Carson, thanks so much for joining us today.
Yeah, thanks for having me, Adam.
Hey, it's such a pleasure to have you back, Carson. I really enjoyed our first conversation and sort of the audience. So I've been getting a lot of requests, say, hey, when's Carson coming back on? So thank you for making the time here. Happy New Year, by the way. We're here still at the roughly start of the year. So to my question there in the intro about short selling, obviously, Carson, you're one of the best in the business. Valuations, when we talked last, were pretty stretched. They seem to be, in many cases, even more stretched right now. But looking at some of your recent writings and work and interviews, it sounds, and correct me if I'm wrong on this, but it sounds like you think the current cycle still might have some juice left to run. I don't get the sense that you're saying it's time to go short. Is that correct?
Yeah, so I guess it might be fair to characterize me as somewhat of an apostate in the short selling world. But, the comeback there is it's now a very, very small world when it comes to short selling.
Yes.
So there there are a few things here. The, when you talk about valuations, okay, prices have definitely decoupled from economic or fundamental value in a number of instances, especially for companies that are larger portions of popular indices. But the thing is, what there are reasons why that has happened, and you have, and this is a rabbit hole we've gone down a lot in our firm the past couple of years, where it really started with, well, okay, it started by getting beaten up on shorts for a number of years, right?
Mhm.
And got into these conversations, especially a guy named Mike Green of Simplify Asset Management, who's been out there banging the drum for years about how passive investing is warping markets.
Yeah, and sorry
And
to interject, but just to let you know, this audience is pretty familiar with Mike and that passive bid framework.
great. So I know Mike, and we started conversing about this, maybe late 2019, early 2020. And what then ended up happening is we had somebody in our firm who ended up developing a systematic strategy, a momentum strategy, where we were going long constituents of the S&P 500. And, it was just, we were measuring momentum in a way that's proprietary. But I was skeptical when he presented this to me, and he showed me the backtest numbers in mid 2024. And I mean, I was skeptical that there was real edge there, and it just sounded like it was too simplistic. But we ended up putting this into practice in October of 24, and I mean, we've shot the lights out. The returns that we've made on this are just they're almost obscene. And I really, as part of this and my conversion to really, I understood the arguments that Mike was making on an intellectual level, but I didn't really, my bones want to believe it fully because of my
Hmm.
orientation as a short seller. But having taken advantage of this effect, um, I do feel this in my bones. But we've gone down the rabbit hole, and look, we're not complimentary internally of the index providers, especially S&P, right? Like those S&P chases momentum when they add names to the index, especially the S&P 500 index, and the dynamics of market cap weighting create basically this recursive effect where
Hmm.
momentum just feeds upon momentum, and then the smart companies, which a lot of these companies understand these mechanics, they play into it through share buybacks. And so it that's why you have so many of these large companies where the prices are disconnected from what you would say the fundamental value should be. But should you short that? I mean, no. So long as you continue to get flows into these index funds, that effect is going to continue, and the fundamentals matter less and less. Yes, fundamentals can matter on the margins if there's a bad quarter, but again, it could that could shrink its given stocks percentage of the index. But if it's still on the winning side of that index, it'll continue to get flows. So it'll kind of just grow back up in proportion of the index. So no, you shouldn't go and in short Mag 7 because you think it's overvalued or what have you. What I think the future of traditional short selling is, now keep in mind, my firm, we're not traditional short sellers, we're activist short sellers. So
Yep.
for us, the idea has always been to use short selling as as an absolute return strategy. But generally, traditional short selling is not absolute return. It's there to smooth out volatility over the long term and also to allow you to finance your longs, the ones that you really like. Well, the case for traditional short selling as a volatility hedge or as a downside hedge, it's not really there anymore at present, or because when we have corrections, the corrections are so short in duration because the policymakers absolutely must prop up the markets. I mean, we are so, as an economy, we are so heavily financialized that we cannot weather the pain of a real market correction or a severe market correction. So policymakers have the motivation, and now they have the intellectual property. They developed it post GFC, and you really saw this put to use in COVID when that correction was so short in duration. So that's why that traditional view of, well, I want to allocate to short sellers as a hedge, for when the market corrects. That's why that no longer holds water. But to finance your longs, yes, but the problem that, short selling traditionally has been this discipline where you go out there and you say, okay, I want to find the companies where the price is the most disconnected from the value. Another way of phrasing it is, I want to find the most screwed up companies. Now, when you get those massive disconnections, it's almost always because the company is actively doing something to cause that. They're hiding the ball, they're misleading investors, they're doing things to manipulate the perception of the company. So in this environment, trying to identify those shorts to use them to finance your longs basically is a bad idea. So if you look at any given index and you break it down into quintiles or deciles, right, that leftmost, in terms of the ones that underperform ultimately, where they really crash, that's what everybody's searching for in terms of their mentality. But the thing is, a lot of those that ultimately have those spectacular crashes, they just run hard. They rip
Hmm.
for an unknowable but often long period of time before they crash. So rather than chasing that leftmost quintile or decile, I think that the discipline, if you're a traditional short seller, as in non-activist, needs to be that you're going in there and you're looking for the quintile or the decile that's going to be just a little bit to the left of the index mean. The mediocre companies that are kind of just sleepwalking through things, you're not finding anything revelatory. You're not really finding things that the world doesn't know. You're just looking for those who are lagging the average, the mean performance of the index, which isn't that hard because it's only usually about 20% of the companies in, like an S&P 500 or a Russell 3000 index it's only about 20% of those companies usually that equal or exceed the mean of the index performance. The mean
Or in
is
the S&P
driven,
case, 20 companies, not
right.
20%.
Yeah, exactly. Like that mean is driven by a really small number of companies. So rather than looking for the ones you think are going to be the worst, just look for the ones that are, kind of, somewhere in like the second, third quintile, um, or the third to, sixth decile, basically. That's where I think, and you know what? And that's a horrible job. Like it's not intellectual. Smart people don't want that job. So I think that's why, as a practical matter, it would be tough to make that adjustment. But that's the adjustment that should be made if you say, hey, look, by being short these things that are kind of mediocre, that are just going to underperform, I can really concentrate more in the things that I have confidence in, that I really like, because when there is, beta move downward, I will have some cushion there, but I'm not looking at this as like an insurance policy, because I think the market's really volatile and going to crack hard. And, I like it's not a pre-GFC market anymore. You just don't have the frequency of corrections and the duration of corrections that you used to have.
Yeah, and it sounds like that because there's several things that are going on. I don't know if we can call them unnatural or not, but they are trends that weren't there, let's say 20 years ago, that have a strong bias to keeping the market supported here. And this audience, Carson, it's not a bunch of aggressive short sellers, but I think there are a bunch of people in it who are believers, long-term believers in that stock should reflect fundamentals. They're looking at these distorted valuations ratios, particularly given the scope of history, and saying, "Oh my God, they're at historic extremes. This can't last. Maybe I should go short this, right?" And I hear you saying, folks, it's a risky game, and a guy who's very experienced in short selling like you. And we'll talk about the difference between active and passive short selling in a second. You're basically saying, I wouldn't touch that. Or if I
Yeah.
would, I'd do it in the very boring way that you just mentioned.
Right, exactly. I wouldn't be looking to hit home runs on the short side if I were doing this in a non-activist way. But yeah, just so long as you have net positive inflows into into the index funds, and a lot of that's target date funds, the 401ks, without a meaningful rise in unemployment, that's going to reduce contributions to the target date funds and cause people to draw on those retirement savings. Until you get to that point, you're just fighting this incredible river of money. Now Mike Green does say, and I don't disagree, that the fragility of this situation is significant, but I don't think, we're anywhere near where we have to worry about that fragility, basically, where the flows start reversing. Because
Yeah.
yes, when the flows reverse, you don't have a lot of active managers left to catch these falling knives. And because of the disconnect between prices and fundamental values, especially with the larger names in the indices, because that is such a large disconnect, those knives would have a ways to fall anyway, even if you did have a lot of active manager dry powder on the sidelines. So it is a very worrying, from a long-term perspective, it's a very worrying situation. Um, but I'm not presently. I wouldn't lose sleep over it. In the near to medium term.
Okay. Well, and so I got a bunch of questions I want to ask you that I asked Mike, but I want to hear your answers to them. Um, if we can, let me just give you the open invitation here, Carson, which is if and when you get to that point where you start losing sleep, after you've told your Muddy Waters customers, you got an open invitation to come on here and tell these folks as well.
Well, I mean, look, okay. So from a short seller perspective, I mean, again, you said we'll go into what activist short selling is versus non-activist or traditional. I mean, we've done well in these bull markets. So it's never easy on the short side, but
Right.
I'm reasonably sanguine about that. I
Right.
mean, if we
Hey,
get
sorry
to
to
the
interrupt, but
point,
just so folks understand activist, um, that's where you actually can sort of have some impact on the destiny of the company. right? Where you see a company, you think it's doing something distortive, kind of deceiving the market, and you say, okay, you know what? I think I can, take a short position on this company, and then I, as an activist, can come in and I can kind of poke that weak spot and hopefully make the market aware that this company has an Achilles heel that maybe it didn't realize before. Is that a good sort of simple summation?
Somewhat. I would add to it that the focus on in short activism is on the past, right? So it's just, did the company accurately present material information? Did the company present all material information? So the first one is, has the company told a lie of commission? Has the second one is, has the company told a lie of omission? And
Hmm.
the third question is, does the market understand the information the company has disseminated? You
Hmm.
usually don't get a misunderstanding without either a lie of commission or a lie of omission. But basically, we're looking for companies that have egregiously misrepresented things in the past. So we're not out there saying like, oh, this competing product is, it's a lot better than people think, and it's going to take market share. We're generally not looking into the future. So
Yeah.
it's
Just
backward
saying, hey,
looking.
hey,
So
these guys cook the books, and I've got the receipts here now. Yeah.
yeah, it's very similar to journalism, like to
Hmm.
investigative financial journalism. So,
Yep.
we are investigative financial journalists when we do this. Our revenue model, though, is shorting the stocks versus selling ads or subscriptions.
Right.
Um, but so that, that it gets harder, I mean, every year the market goes up, investors are more and more anesthetized to risk. But on the flip side, the more egregious behaviors that used to be confined to lower rungs of market cap, well, now you find them in companies that have more cap and more liquidity. So we'll do okay there. Now, will I lose sleep when I think we're getting to the point where markets are going to implode? I guess, yeah. I mean, look, I haven't been there since COVID, and in COVID, I definitely lost sleep. But yeah, I don't see that. I don't see that on the horizon, imminently. But certainly, I'd say for most of these financial crises, I've been early in my life. Back in, I think, 95 or 9, no, 96 or 97, I started calling it a stock bubble. Um, Good thing I didn't know how to short at that point.
Right. Because it still
2000,
had 3.5 years to run from that. Yeah.
yeah, 2003, I started calling it a housing bubble because I was like, there's no way homes can go up double digits, when
Yeah.
inflation is this low. Good. I mean, unfortunately, I didn't buy a house at that point in time because I thought that it was ridiculous. So,
I'm right there with you on that, brother.
yeah.
We
So
knew too much too soon. Yeah.
I know, right? Like, you know, one of the best and truest things I've heard said about investing and maybe just life in general, but especially the investing industry, is that when you speak with them, pessimists sound smarter than optimists. Optimists live in bigger houses.
Yeah. Yeah. All right. Very well said. Well, all right. Well, look, just to reiterate, if and when you get to a point where you start not sleeping well on this, please come on the channel and let us know why. All right. So, I've talked with Mike at length multiple times about his passive flow framework. Actually, I'm going to actually see Mike in person in 2 weeks, so I'm looking forward to that. So that should be fun too. But uh, Mike, first off, he doesn't like this, right? He's not happy about it. He doesn't think it's healthy for markets. He thinks that it is distorting prices, and at some point, if and when these capital flows go into reverse, these net flows go into reverse, he thinks it's going to be highly damaging to a whole bunch of people. But it sort of just is what it is, right? We trade the market we have, not the market we wish we have, right?
There you
Um,
go.
so, I often ask him, okay, well, what are the most likely contenders in your mind to change the status quo here? And generally, what I hear from him is it would probably have to be a weak enough jobs market that the monthly flows that are coming in from these retirement plans, they start shrinking, right? You've had enough people laid off that there's just fewer funds that have to be invested every month, and as that starts shifting from net growth to shrinkage, that's kind of when the wheels come off of this thing. Is that your top contender as well, or do you have a different understanding?
Yeah, look, my views are highly influenced by Mike. And look, I've read some of the same source material he has, but that that is my view as well. That once you start getting enough layoffs, such that there are more people withdrawing money from their retirement accounts than contributing to them, then yes, I think that that's when the wheels fall off.
Okay. Let me ask you this. So obviously, if the unemployment rate spiked above 6% or whatnot in a short period of time, maybe we could have that, right? What if we
Hmm.
just had a jobs market that didn't grow much? So unemployment kind of, or the employment levels kind of stay where they are, but we have more and more every month baby boomer retirees who are not working anymore and are starting to withdraw. Will that demographic wave eventually pull this thing under?
Well, yeah, and then you also have, it's not just that the baby boomers who are retiring, but then you also have, those target date funds that are targeting the eventual date of your retirement. They shift more from stocks
The
to
bonds.
bonds anyway, so they're selling those off. Um, I mean, but there's still somewhat of a, as bonds rise in value, then, you have to still have to balance it by buying equities. But yeah, I mean, there are conditions under which even without an abysmal unemployment rate, and look, I'm not really the person to ask what that rate is, but you said 6%. Like 6% doesn't scare me. I mean, I
I pulled that
remember,
out of the air. Maybe it's
yeah,
not big enough. Yeah.
I mean, I remember when I was at USC as an undergrad in the mid 90s and was taking one of my 200 level or 300 level macro classes courses, and I think we said that the natural unemployment rate, the estimate at that time for the U.S. economy was in the low sixes. And, I
Oh,
mean, and we've gone well below that, obviously. So, now, I mean, of course, the flip side is that labor force participation rates have dropped.
has dropped.
Um,
Yeah, we've got over 100 million U.S. adults not doing anything or considered outside of the workforce. We'll put it that way.
yeah, yeah. So, but basic, I mean, I guess that's the other problem, right? When you get into, if you're really going to be focused on the number, what is the unemployment rate? I mean, there's so many caveats to the unemployment rate that, and other government statistics, obviously, plus the fact that I'm not sure that, BLS is going to produce bad news, for at least the next 3 years anyhow.
Right.
I don't think you can, I don't think it's smart to try to come up with a number. The employment rate hits this, then I'm going to panic. I mean, you'll understand, you'll feel in your interactions in the economy. I mean, if you can find a babysitter easily, worry. Like I can't
That's
ever
it.
find one.
That's a great real world indicator. Look, I was asking the question not so much to try to peg the magic unemployment rate, but just to ask, does this thing have an inevitable expiration date on it because of the demographic boom? Will it get so big of the retirees that their withdrawals will force this thing negative at some point?
Look, that's the theory, but the other countervailing force, and I alluded to this earlier, and I do think that Mike, talks about this as well, maybe not in this exact context, but it's the fact that policymakers have no choice. So I, in a pithy way, I like to call our financialized economy the powder keg economy, right? Because, we stuff it full of powder, which is leverage. It eventually blows up, and the only response is to build a bigger keg and put more gunpowder into it.
Mhm.
And so, with some actual preparation, not that the government believes in doing that anymore, but, maybe we'll actually get to a point in our politics where some foresight is actually politically rewarded and enters the system. So I guess what I'm saying in a sarcastic way is that we might end up, we might end up anticipating this. We might end up preparing for it. It might not be the sky falls in. Warren Buffett was always fond of saying, never bet against America.
Right.
You know, uh, Again, my best feeling is that there's no imminent issue. And, short of like those UAPs attacking us and destroying humanity or something like that. But, I guess it doesn't really matter, if you're long or short financial assets at that point. But, yeah, so I think don't lose sleep over it now. As the problem, as it becomes more obvious that where the flows start netting out, on a more frequent basis, um, then, assess the situation. And maybe there are preemptive policy measures that can be taken, or, you know, maybe it's maybe it's time to go to cash and, just get out of the way.
Yeah. All right. Let me make a statement here, and you correct it in any way you like. So what I'm kind of taking from you, Carson, is sort of like what I take from Mike is, I don't love this, but it's the way it is. Um, these are my words, not yours. Um, the passive bid is kind of like a sword of Damocles hanging over investors, where everything's fine as long as the thread doesn't break. We just have no idea if and when that thing's going to break. But right now it's holding. And so right now, you know, you're sort of like, I've kind of learned to love the passive bid as an investor because I can use that to make money. I can use that to outperform. And so you're choosing to do that, but you've got, one eye always up at the sword, trying to look at the thread and seeing if that thread looks like it's getting any thinner. Right now, you're not seeing any near-term signs, so you're dancing with the devil, if you want to put it that way. And you think that could continue for a good long while. So until you see signs of that thread starting to fray, you're going to put this to your advantage on the long side.
Yeah, look, because if you go back and you look at the last three major crises, well, let's look at the last four, one of which wasn't a financial crisis, but it was layered on top of the internet bubble burst. Okay, so the internet bubble bursting was foreseeable. The timing, no,
Yeah,
that it would be in March of 2001. No,
right.
that wasn't foreseeable.
But guys like
But
you in '97 could see this is probably going to end in tears.
right,
Yeah,
right. That 2008, the implosion of subprime, the implosion of real estate, the implosion of credit, that was foreseeable. There were a number of people who did foresee that. Um, Now, 9/11 was not foreseeable. Its immediate financial impact, was material, but not, but it obviously was worse coming on the heels of the internet bubble bursting, but it wasn't that significant. But that's something that's unforeseeable.
yeah,
COVID was unforeseeable. So yeah, you can always have a black swan event like that. But what I think, and COVID taught me something that actually was formative for me in terms of, my apostasy, I suppose, as a short seller, which is there is a tremendous resilience to our society. And so as fragile as the market is because of passive, people are resilient. And like it's unfortunate that a lot of times the things that are glaring problems never do get addressed until there's a crisis, but
right.
they get addressed, and we have successfully addressed these. And I remember in the early days of
And
COVID.
sorry to interrupt, but I mean, addressing to your point of the powder keg economy, it's rarely by fixing the issue, but just by window dressing it enough that it doesn't look, or maybe not window dressing, but artificially papering over it so that we can
Well,
continue.
Well, keeping it going. I remember, so back in 2005, I sat down with a friend of mine. He's really a friend of my father's. He had his own global macro investment firm since the 70s. And I mean, he was really one of the early American EM investors, actually. And his name is Monty Guild. And so I sat down with Monty, and I'm just like, oh, the housing, we're headed for another Great Depression, and this is like there's no way out of this. And Monty said to me, he's like, look, I agree with everything you're saying about the problems, and I do think we are going to have a real correction. He said, but when I was a young man like you, I used to think that and I'm talking the 1970s, the 80s, I used to think that the global financial system, was too fragile of an artifice that it couldn't hold. And and I was waiting for it to implode. And what I've seen time and again is they can put the toothpaste back in the tube.
Yeah.
And I think that's correct. And I philosophically don't agree how they did it. I mean, in 2001, or I'd say by 2002, I was apoplectic, looking at the response, to the internet bubble imploding, just to cut rates to, I mean, back then they seems like they were, like we thought we knew what, zero rates were, but
child's play back then.
yeah, I was apoplectic about that because to me, this did not address, what I kept saying in 2002. My verbiage was surplus capacity. We'd created all this surplus capacity in the economy through unproductive capital investments that were funded by artificially cheap money. And, it's like, so we're just making money even, artificially even cheaper. But I don't agree with the methodology, but the results speak for themselves. They do put the toothpaste back in the tube. And we saw that following the GFC, which, they didn't have those tools, and they also didn't have the political will back in 1929 to do this. So they do have the political will now. We're trapped in this cycle. I mean, in theory, we come to this, we come to this juncture in the road someday where you can't do it. But then look at Japan. I mean, this is, Japan's been doing this for a few decades. I mean, back when Japan started just, trying to reinflate its deflated bubble, you had all the Western economists, saying, oh, this is wrong. You can't do that. It won't make sense. It won't work. I'm like, it's not that Japan's is without problems, but they've kept that going for, 35 years now. So because there is a societal need to fix the problem, I do believe in this resilience. And look, to me, the real smack in the face that taught me this was during COVID, because I had, a good friend of mine I'd known for a number of years, professional investor, he went out and started buying shares in the cruise lines. Mm-hmm. And look, I'd already felt that cruises are just kind of nasty, like they're floating petri dishes.
Right,
and now
right.
like everybody on them is getting COVID. And
right, but they were radioactive during COVID. Yeah, exactly.
Yeah, and I'm like, dude, nobody's gonna go on a cruise after this. There's, that industry is ruined. And he's like, no, they're installing sneeze guards. I'm like, sneeze guards won't help. It's aerosol. Like, and he just went on buying, and I went on freaking out. And guess who was right and guess who was not right? Yeah. He was right. Cruise lines rebounded. He made money. And, in July, actually it wasn't until August of 2020 when everything's ripping, and we're like, yeah, we got to reduce short exposure here. Like all those easy gains we had early in the year, we've given many of them back. Mm-hmm. So, so I've learned the hard way. And, the phrase that, you've used a phrase a few times during our conversation here about, that's very similar to something that I say. It's a criticism of short sellers. And that is, and look, this was true of myself, and hopefully no longer is, but, on the short side, I think we really have a tendency to see the world the way that it should be, not the way that it actually is. Mm-hmm. And, and that's also the case with businesses. When you go and you short a company because you're like, there's no way they can get out of this. That's also failing to understand that people are resilient. I mean, Tesla's a great example. How many times over the years have the Tesla shorts just screamed that Elon's done? Nobody is more resilient than Elon Musk. Look, I used to be one of them. I thought that he basically jumped the shark in 2018. Mm-mm. So, you can't overlook the resilience of people, of companies. Not every company avoids failure. Not every company bounces back, but I do think that, as a society, and it might not be pretty, and I might not agree with how we implement the recovery plans, but we are resilient, and just people just need not or should not lose sight of that.
Right. Or I'm taking from you is discount that resilience to at your peril or your danger. Um, all right. So I've actually, this is going to be a great bridge to a question I have here for you. Um, one other thing too that I'm kind of taking from what you say, and I've mentioned this in the past, is um, it's resilience, it's what you're talking about, but it's also just self-preservation of the system. So if you're betting on a reversal, you have to just keep in mind that every part of the system is fighting you, right? It's fighting to, the people that are benefiting from the status quo, the big parties that we all love to hate, they're going to do whatever they can to keep their advantage. Everybody in government is going to do everything they can to keep any sort of pain from lasting for very long. And even the public themselves will oftentimes ask for more of the same type of rescue that guys like you and I think have created the distortions. But I think, in COVID, we let a new horse out of the barn or genie out of the bottle with direct payments to households. And I think we can probably feel pretty confident the next time things start feeling painful, public's going to ask for that again, and politicians will probably give it to them. So you have to just keep in mind that this whole system is fighting you.
Right. Yeah. And the thing is, when you have an potential economic calamity, that's deflationary. So what does that automatically create license for, you know, the central banks of countries that borrow in their own currency, or really the US? What does that create license for the Fed to do? Print money,
Brent.
right? It's, and I mean, what it ends up doing is redistributing, right? Like there are on the back end of that. I mean, even if you say, well, in aggregate, GDP has increased, but there's obviously a transfer from you know more people to fewer people, because especially if you're long financial assets when you catch that reinflation wave. But so it's not to minimize the deleterious effects of this, but the reality is that's the policy response, and they have a lot of room to maneuver. And again, going back to what people what I think people get wrong, there I don't know that I'm not going to argue that the Fed and Treasury, are stacked with like our smartest minds, but they have a lot of people, and there are lots of people who spent years, theorizing as to what the proper policy responses should be in a Great Depression type scenario, or edge of the Great Depression, scenario. I mean, Ben Bernanke had written, that was, I think he wrote his PhD thesis
Well, that's what they
on
called him, Helicopter Ben, because of his PhD thesis.
yeah. So it's so they'll the biggest problem that the U.S. had in terms of trying to stave off the GFC when Lehman failed was a political one, that the authorities did not exist. Although it's kind of funny, they suddenly found the authority when it was AIG, not Lehman, because AIG was like that was the real like holy shit type moment there. But they'll eventually the politics will line up, and what needs to be done to try to pull things out of the nosedive will happen, and they'll probably succeed.
Okay. I'm getting to the question I referenced, but now I got to ask a question that I think is on a ton of people's minds, which is, um, hey Carson, I get it. Maybe I'm a little surprised at your new apostate role, but I'm following the logic that you're mentioning here about not to step in front of this juggernaut prematurely. Um, but I'm worried that, if the system does get out of control for at least a little bit, you're saying, yes, the reaction function of the central planners is going to be fast and furious, but I don't want to be collateral damage in the period between when the thread of the sword of Damocles breaks and then the central planners respond. I don't want to lose 30%, half, 50% of what I have if there's a big drawdown there. Um, Do you worry let's say the sword thread snaps for a bit. I know you think the policy folks are going to respond as quickly as they can, but in the interim, how bad do you think it could get given the distortions of the system?
Well, I mean, certainly equities, would be pummeled. I mean, your S&P 500 index, and nominally, right? Because those companies that had led the way up are going to lead the way down,
Hmm.
would be, I mean, it would be a crash. Um, that would certainly have knock-on effects. I mean, you'd immediately have, credit markets responding and credit markets I mean, liquidity would recede
Ice
instantly.
up, yeah.
Yeah. So you would have real world layoffs. You'd have diminution in other asset values. It would be, I mean, it would be similar to the GFC, but probably the movements, the downward movements in the markets would be more profound. Um, so, I mean, in the short term, look, you know, as as a matter of just general principle, you don't want to have too much leverage, right?
Right.
And this is
Hmm.
also where having a real asset and so owning a home, but not having too much debt on it, would be a benefit, right? Don't have all you certainly don't have all your eggs in the equity market basket. I mean, particularly if you're at the point in life where you're middle aged or older.
You don't have a lot of time to recover. Yeah.
Yeah, you don't have a lot of time to recover, and you don't want, and if you have a job where if the job goes away because of damage to the real economy, you do want to have a cushion. I mean, if you're listening to this and you're 26 years old, I mean, you can't wave a magic wand and suddenly have, reserves, but then on the other hand, time is on your side.
Hmm.
So yeah, I just think it comes down to, at the end of the day, you have to be prudent and you shouldn't ever get too greedy. So if you're hearing me talk about, the equity market, at least the index, that's going to rise until, the world falls apart. Okay, like, if you like that thesis, fine. You want to play along, great. But don't go all in or anywhere close to all in on that. Right? You know, have a cushion there. So that's, I just think it's basically, that's where I know a lot of people in a bull market, people will deride diversification as diversification. And
Right.
like, yeah, okay, but where it works is when things do become somewhat semi catastrophic.
Okay. Um, and in terms of duration, I know I'm asking you to prognosticate a lot here, so I understand that this is just gut feel here. We're not holding you to any of this. But going forward, it sounds like you think that market downturns like this, or we'll call them sort of systemic downward surprises like this, they're gonna be more kind of like the COVID era in duration versus the GFC era, right? GFC, we had multiple quarters of it just feeling terrible, and it took a while before people started to feel like it was getting better. COVID was almost kind of like you blink and you miss it, right? Markets
Hmm.
plunge, but then they recover pretty damn quickly because the reaction function was so sharp and so unprecedentedly massive.
Right. Well, yeah, look, I think, I do think that's the case. And actually, I hate to do this to you because it's kind of out of sequence. I mean, there is one potential black swan out there that I see that I don't think it's a near term risk. It's probably not a medium term risk. I do think that among insurers, there are a lot of problems. I think there's a
Mm,
systemic problem among insurers because, you've had this situation where a lot of insurers have been acquired by private equity. These ratings agencies that, will rate the bonds are, once again, reasonably pliable. I mean, actually, let's call it corrupt. And so they're using the assets to fund LBOs to basically build their businesses. The other thing that's really funky about a lot of insurance, and I've never understood the case for this, is you have captive reinsurers. And those captive reinsurers are often in jurisdictions in which you have very little transparency or visibility into the financials of the reinsurers. And so, what a game that I suspect a number of insurers play is, they cede, liabilities to their captive reinsurers, and they'll inflate the value of the liabilities that they've ceded, meaning make their balance sheet appear to have fewer liabilities, and
Yep.
they'll inflate the value of the reinsurance asset that they get, because probably the stuff that's on the balance sheet of the reinsurers, even bigger garbage. So I do think that that could be a systemic type issue, especially because, and speaking with somebody recently who's done work in this space, he said that like a lot of these really the poorer insurers are just reinsuring to each other. So you have this like web of like crappy insurers, or poorly capitalized insurers that are reinsuring each other's, balance sheets. Um, but a lot of times these insurers issue life insurance and annuities. So these are long tail liabilities. So it's not clear to me that there's an imminent risk, but you know, again, like let's say that blows up. And so if you had that blow up in a big way, one, I think you would see an immediate impact on the credit markets. You would have liquidity would recede, because these guys are obviously big players out there in terms of providing liquidity for,
Right.
acquisitions, et cetera. Spreads blow out some, but I just think, the government has the toolkit to go in and fix it. I mean, maybe there's, a gap there during which there's some real world pain, but, rates get cut, Fed buys bonds, does what it has to do. So, but that's another hiccup. I
Uh,
shouldn't call it a hiccup, but that is something that I do see that could be a problem at some stage.
that's super interesting, and I'm resisting the urge to try to peel that onion with you. But given the time we have left, I want to squeeze in a few more questions before we're done. And you answered my big one on that, which is when you mentioned it, I was like, whoa, what happens when the backstoppers can't do that anymore and need their own backstopping? But it sounds like you think it's not a hole that's too big for the Fed and the other central planners to fill.
I mean, again, like that's the beauty of all these problems. They're deflationary, right? So that gives you lots of headroom to just print money. Now in Europe, the response is always going to take longer because, you've got multiple nations that have to agree, the ECB, none of them, they all borrow in a common currency, not their individual currencies. So for them, they're always going to move more slowly. But,
Right.
in the US, to date, um, it's a great thing that we get to borrow in the currency that we print.
All right. Great thing for us that benefit from it, and that's largely the asset owners. Not a great thing in the long run, especially for those who don't own assets. And you're nodding as I'm saying this. All right, if you don't mind, then just given the time, I want to do a little bit of rapid fire with you, if we can.
Sure.
And by the way, Carson, this is great. I'd love to have made this a 3 hour interview, but I understand we got to
There's
be
not a market.
respectful.
There's not a market for 3 hour interview with me.
It's funny though. I have yet to find the maximum tolerance level of this audience. I've done some interviews that have been 2+ hours and had people say you should have kept going. So it is interesting. There is a cohort of very thoughtful people out there that really like this deep discussion. Um, so I was just listening to an interview with we were talking about the All In guys with Chamath was interviewing Howard Lutnick, and it was actually really just it was super fascinating. I recommend it on X to anybody who just wants to get a better understanding of our tariff policy, and love it or hate it. I think it's a really educational discussion about kind of just why the current tariffs were structured the way they were, how they get structured that way, and then just mechanistically how it all works. So super interesting. And I'm not saying you have to necessarily share this, but listening to folks like Lutnick and Scott Bessent and whatnot, I mean, obviously they're going to be putting out the best, most optimistic guidance they can because they're the guys that are running the system. But they are really saying, hey, look, we have laid a lot of pipe in 2025 for economic tailwinds that are going to start beginning this year, and some of them are kicking in now. And they're saying, look, don't be surprised to see 5%, maybe even 6% GDP growth here in 2026. When it comes to the current estimates for GDP growth for 2026, are you more willing to take the over or the under?
Um, I thought this was going to be a tariff question, you
Yeah,
know.
sorry.
Um, ah, yeah, I'll go with the I no view on that now, but I do have something on the tariffs
Sure, go for
though.
it.
One of the things, because we've done a lot of work in Vietnam, we have an office there, got a tiny fund that's been investing long in Vietnam. And one of the things that we learned from that was when the tariffs were imposed, I think this speaks to why they're a bad idea, but also why they don't really seem to matter when it shows up. Um, is that all of these exporters and also on the import side, same incentives. They basically said, oh well, you know what? Actually, since these tariffs are only levied on products, well, there's a lot of IP that goes into my widget, and so basically what we're going to do is we're going to say that, this is really IP, it's a service. So when, the manufacturer, the exporter, I'm selling this to you, this portion is actually the IP I'm licensing to you. So the widget cost is much lower.
Huh.
And so like, that's why I don't think it's mattered much, because everybody has then tried to engineer around it so that it's not that impactful. Why that's a bad idea? What is that like? That's exactly the US tax code. Okay. The higher you make taxes, the more guys who can afford it, like, pay, just, I mean, when you step back, I'm not like a huge Arthur Laffer fan, but I heard him interviewed once, and he was just talking about what an absolute waste it is that we spend so much of our wealth on guys who are trying to figure out how to engineer, like, through the cracks of rules and
Right.
laws, tax savings. So like, that's basically what I think we've, the net result of tariffs is, I mean, obviously there's some increase in the cost of goods, right? And the Treasury has collected some money, but the reason I don't think it's really been that profound is because you've just forced people to, turn into high income American taxpayers, and higher, think of creative ways to, minimize the taxable values.
Okay. I'd love to dig more deeply in that too, but we'll have to say that for a different discussion. At a higher level, let me ask you this. Um, the world does seem to be fracturing into trading blocks versus the era of globalization that preceded it. Um, in this new world trade order, um, if you're looking at the risk board, um, whose prospects do you favor most? US, China, somebody else?
Well, so that it's actually that, my mention of Vietnam was great, because in April of 2020, my revelation was that coming out of COVID, it was going to be the biggest geopolitical realignment since World War II. And it was going to be about each country in the world, its relationship with China. And so what I saw as the biggest net beneficiaries overall be the countries that are non-aligned. So like your Vietnams or Indias. I mean, if you look at Vietnam, for example, Vietnam does not like China. They cannot, they cannot ever trust China. But by the same token, they cannot anger China. And, it's interesting, the Vietnamese perspective on the war in Russia and Ukraine shortly after that war started. What Vietnamese government officials would say is they thought that was actually Ukraine's fault, because Ukraine did not balance its neighboring giant with the West. So I think that the winners, the biggest beneficiaries of this world are those that can play the United States and China off one another.
Okay, so maybe poor analogy, but sort of the Switzerlands of the world, the countries that can be more independent versus just bolted to one superpower.
Yeah, yeah, exactly. But I mean, from a trading and economic perspective, I mean, Switzerland doesn't have like a ton to give the world anymore. But from but I really
Exactly,
like
which is why
countries
it's not the world's best
like
analogy.
Vietnam.
Yeah.
Yeah, but like Vietnam and India. And I mean, look, we're very bullish on India. We're in the process of launching an India fund as well. So and this is not just me talking my book. Our book is reflecting that, my worldview there, that these less aligned or non-aligned countries are the ones that are set to benefit the most. I mean, obviously, look, with the problems in the relationship between the US and China, that's bad for the US in certain ways, that's bad for the Chinese in certain ways, it's bad for the Europeans in certain ways. But so the countries that were kind of insignificant and aren't really the movers and shakers of world affairs, they're the ones that I think are best positioned.
Okay, great answer. Um, all right, so uh, I'm going to ask you about gold, and I'm going to ask you about gold for two reasons. One, because when I was doing research for this discussion, you've had your firm's had some comments in the news about gold. You also mentioned, you know, the prudence of owning some real assets in the current environment, as you told us a few minutes ago. I do have to say, though, before I ask the question, um, uh, it sounds like your firm has taken a long position, or at least identified as a good long-term play, or sorry, long play, a company called Snowline Gold. And I mention this only because I own Snowline Gold. So I've got
Oh,
a selfish interest in your answer, but I also just want to be transparent here, folks, that I'm asking a question about a company that I actually own in my personal portfolio. But gold and silver have had a phenomenal year in 2025, and the momentum is continuing as of the day we speak. I haven't looked at it since we've been talking, but this morning, silver, I think both gold and silver futures hit all-time highs yet again. Silver was like 89 something. I mean, bananas. uh,
mhm.
so, one, I'd just love to hear any thoughts you have right now about kind of what's happening with the metals, what you think might be driving it, how sustainable you think this is obviously the big question on a lot of people's minds who have been precious metals investors for a long time is this the great repricing we bought in for and we're hoping for, or is this a blow off spike like we saw in 2011 and 1980, and is this going to come crashing down and be dead money for the next 10 years? So love to get your thoughts on that, and then anything you want to say about Snowline Gold, I'd be very interested to hear.
Sure. All right. Well, I'm gonna disappoint on the first one. We launched a junior mining fund in 24. I mean, had phenomenal year last year, even though we run it on delta adjusted basis, only net 50-60 long. Our macro thesis on launching the funds didn't have to do with metals prices, though. And our macro thesis on why you should invest in junior mining if you know what you're doing is that there's been a massive underallocation of human capital to the mining sector for the past
Mhm.
couple of decades. Smart people have not I mean, it's a miserable lifestyle to be in a mine.
They've been running out
Um,
of engineers, right? Like the
yeah,
folks just don't
yeah,
want to go into that
right,
profession or hadn't wanted to. Yeah.
right. So there's real edge if you know what you're doing in looking at junior miners and interpreting the data. And look, we brought somebody in who does, in my view, have real edge. Otherwise, we wouldn't be doing this. So, we don't, our macro thesis had nothing to do with the metals. I mean, look, at a high level, we believe, to the extent that, society does get serious about increasing the amount of electrification of, of our economies, like that means a lot of stuff needs to be pulled out of the ground, the base metals, particularly copper. Um, as for gold, I mean, yeah, look, everything I've said about the consequences of our financialization of our economies and the policy responses, you know, does imply that over the long term, like gold is going to continue to go up and to the right. I mean, gun to my head, do I think it really corrects for a sustained period of time from here and that these are like all-time highs? No, I do not. But that's not really, that's me somewhat outside of I'm definitely outside of my lane on that one. For us, it was really about the lack of human talent in the operating space and also capital allocation side of resources. As for Snowline, yeah, I mean that to us, we think a major is going to have to acquire it. I mean, majors have not spent much money on greenfield exploration, since the GFC, and I mean, Snowline is really the only deposit. I mean, and first of all, it's in a functional jurisdiction, right? It's in
Hmm.
it's in Canada. We think it has the potential. So some of the concerns about it have been like, well, logistically, it's remote, it's in the Yukon. There is infrastructure there. They will have to develop the road network some, but we think that this deposit, or that these deposits are so significant that this will turn into a mining district, and that Snowline will be the engine for that. So we do expect a major to acquire it within the next, I think highly probable within the next 3 years. And the longer it takes for major to acquire it, probably the more they end up paying, especially if we do see, price of gold continue to trend upward.
Okay. And I don't think I'm saying anything that hasn't been said publicly, but because of that buyout premium, you actively think it's a long to consider if you're interested in this space.
Yeah, yeah, we're long that, we remain long that. So definitely. I mean, we think this is the one real world-class greenfield opportunity that exists in a jurisdiction that's credible.
Okay, great. All right, two real quick questions as we wrap up here. One is there anything that's you're really covering passionately right now, or that's really burning brightly on your radar that I just haven't thought to ask you about yet, Carson?
Um, well, I mean, look, our core business is still activist short selling. Lots of companies out there still doing things that they shouldn't be doing. That's human nature. So, we're still grinding away there. We've covered momentum, and especially within the indices and flows, and why that's it's a space. The kind of returns that you can get shouldn't exist, but they do. I've covered some geopolitics and then also metals. So no, I think I, I don't know that these, and insurance. Insurance is one of these, things that's a little bit of a sleeper. I'm not sure exactly what to do with it. I don't know yet that I have actionable short theses in this space. It's just seen a decent amount of these problems, and so I think someday it will become a systemic issue. But so the fact that we even covered that, I think, has been pretty comprehensive.
All right, good. Well, again, if you get to the point at some point in the future where you're beginning to really actively worry about the insurance space, again, come back on and love to have that conversation in greater detail with you. Just on the Mike Green thing for a second. So I'm taking away from this, and you just tell me if I'm taking away correctly, but one of the last times I talked to Mike, he talked about how his firm Simplify had really isolated this passive factor in a way to be able to trade with it. And it sounds like that's kind of what you're doing there as well at Muddy Waters. So it sounds like you're saying, hey, there's really something there. Like this actually is something that gives you alpha as an investor.
Yeah, and I mean, look, I can't speak to how Mike and Simplify are doing it, but yeah, I mean, if you're looking at, like momentum is real. And what we found, actually, it's kind of interesting in looking at how our book has performed in real world, and also some portion predating October 24, or on back tests, like even this past year, like we were really, our strategy was really not in Mag 7 much. We only had minimal Mag 7 holdings. It was so it can kind of, you can find like this leading indicator. So for example, our largest holding in the strategy the past two and change months has been Western Digital, and also Micron was up there too. And so it seems like there's sometimes signal and momentum that's telling you something that's about to happen. And so the memory squeeze, and when on back tests, when we saw rotate, there was a rotation into energy on back tests that preceded, real outperformance there. So, and, so what, that's one of the interesting things about momentum is we're seeing, and I don't have high conviction in this yet because, I want to run this a few more years before really pounding the table. But at least as we measure momentum, like there are ways you can measure momentum where you find signal about the future in it. That's what that's one of the theories that, we're developing based on our experience here. So yeah, I do think there's something to this.
All right. Well, super fascinating, and I hope it keeps working for you for as long as
Me
you need.
too. It's a lot
Um,
easier than short selling.
I'm imagining, right? Exactly, right? So you can kind of understand the switch to the apostate role. Last question before we get to the most important one. Looks like you rock, do you? I'm basing that off of the picture on your X profile.
Oh no, that was I was doing the Murph challenge. So that was a 20-pound weight vest. I was doing push-ups. I don't know why I put that up there. There's a little bit of a flight of vanity, but
No, no, you should
no,
look, if you do Murph with a weighted vest on, that's a flex. Look,
I
I've
was
done
the only
Murph, it's no
person there
joke.
doing it. I mean, I was the last person to finish because I was the only person with the weighted vest. I thought everybody would have the weighted vest, but yeah, and the only reason I was able to finish on the pull-ups was because my son was there, and I just kept thinking, like, man, you do not want to teach this kid like to give up. Like, I don't care.
Man.
Keep doing the pull-up. So
That's super. So for folks that don't know Murph, it is I think it's a workout that's originated in CrossFit. It's dedicated to fallen soldiers, um, and it is 100 pull-ups, 200 push-ups, and
300 air
300 what?
squats.
Air squats?
Yeah, so
Okay.
you run a
Oh, and sorry,
mile.
you have to run a mile at the start, and then you have to run a mile after you've done all those, right?
Yeah,
And
yeah,
you're doing that
exactly.
with a 20-pound weight vest on?
Yeah, I did that with the 20-pound weight vest
Yeah,
on.
pretty
So
pretty impressive, buddy. Good
yeah.
job.
No, I'm now training for a marathon, be my first, and then I'll start doing some of the Spartan races. I did DecaFit in the fall. That was my first. So
Oh, cool.
yeah, no, I lost over 50 pounds back in 22, and that just kind of got me in this like, well,
You lost 50 pounds in a year. What did you do? Saw
over.
your legs off?
Yeah, I know, right? I, it was medium COVID that caused me to lose 15 in 2 weeks, a very unhealthy way. But I was suddenly sleeping a lot better. My blood test, which I just happened to go for my physical right after that, I thought was going to be abysmal. It was the best it had been in years. And so I said, you know what? You know the formula. Follow it, see how far you can go. And no GLP-1s. From that point on, I dropped another, like 35 to 40 pounds, just eating better, eating less, like avoiding snacking, drinking less, and making the time and exercising regularly. And yeah, so it's just kind of been a celebration of that. And I've got my son now is 12, but he's a really good distance runner. And I just went for a hike one day on a trail shortly after I'd lost 50-ish pounds, and he just took off and started running, and I was like frozen for a moment, and I thought, you're good enough shape, you could probably keep up with this dude, let's try it. And we just started running the trail, and I was like, man, like, this is awesome. I got to see what else I'm capable of. So that's what I'm doing.
Good for you, Carson. So on this channel, as regular viewers know, is a wealth building channel. So we talk about money all the time, but I do try to reiterate to folks as often as I can that money is a means to an end. It's not the end in and of itself. And true wealth, research is pretty clear on. It really boils down to quality relationships, having purpose in life, and good health. And I love it when, you know, experts that folks really respect, like yourself here, reflect back on people that, yeah, I'm a successful investor. I run this, big famous Muddy Waters company. We try to, give great financial gains for our folks. But in my own life, I'm really focused on the things that matter.
Yeah. So actually, can I riff on that for one quick moment
Yeah,
here?
please.
So to me, I like to distinguish, between being rich and being wealthy.
Hmm.
Like in finance terms, I mean, I'm not, I'm not that rich. I mean, look around the industry, guys are, I'm a rounding error. Um, but I think I'm one of the wealthiest people I know, and it's because I've become really focused on how I use my time. And so to me, wealth is the ability to use your time in the way that you want to use it.
Hmm.
So I mean, part of that's saying no to a lot of travel. It's having my own business. It's a mature business. I've hired people to do things, but it's given me the ability to put the time into exercise and to spend all this time with my family. So to me, like that's the goal, I think, is to have control over your time. So
Very, very well said, my friend. All right. Well, look, here we are at the end. Last question for you, Carson. Um, for folks that have really enjoyed this conversation and would like to follow you and your work in between now and your next appearance here, where should they go?
so on Twitter, I refuse to call it X. I'm at Muddy Waters Re. We also have the Muddy Water www Muddy Waters Research website where we post our reports. But yeah, just the Twitter is the best way, and maybe that Twitter account to which you referred, where I posted the picture, that's at Carson_C_block. I'm not really sure what content I should post on that. It's kind of rare, but maybe someday I'll have something profound to say that gets, placed on there.
All right. Well, look, Carson, I can't thank you enough. It's always wonderful, but it just very much appreciate you coming on here, especially so early in the year. Look forward to having you come back on this year. I mean, I'll reach out at some point, but like I said, if there's something that's really starting to catch your attention, please let me know. We'll pull you back in for that. But just thanks so much, buddy, and continue focusing on being the wealthiest guy you know where it matters.
All right. Hey, thanks a lot, Adam. Really enjoyed it.
All right, well, now's the time of the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by the lead partners there, Mike Preston and John Loder. Gentlemen, it's great to see you. John, why don't we start with you? Lots to talk about, a lot going on in the markets as we speak here, but any key takeaways from the Carson discussion you'd like to highlight for us here?
Hello, Adam. Great to be with you again, and thank you for having us. Got to thank you. I think many of your viewers oftentimes so compliment you on introducing them to new voices and names. And I got to say personally, I wasn't familiar with Carson. Enjoyed his talk, and so thank you for introducing us to another viewpoint. I just want to put right out here, and this is not in any way a criticism, just a statement that there are many styles of investing, many tools in a toolkit, and many right ways, in fact. Our toolkit does not involve short selling, and certainly does not involve short selling in the kind of systematic, disciplined way that many firms have taken that strategy as part of their flagship approach. With that aside, I guess I want to comment on a couple of things. Carson did talk about the difficulty of the market to traditional short selling. In fact, we can go back and look in recent years, and there's been some very high-profile names that I don't want to say throw in the towel, but kind of have. You look at folks like, even the movie The Big Short. That for many lay people, that was their first even introduction to what it even means to sell short. Obviously, this was the big tale of the few souls that had the foresight to short big into the housing collapse of 08, 09, made a movie of it and book out of that. So many people, lay people, that was the first introduction to sell short. But almost like one after another, the big names in short selling have thrown in the towel. Michael Burry himself, one of the key characters in that movie, in that book, basically shut down his firm, Scion Asset Management. I think for a lot of the same reasons that Carson spoke about, it being a difficult market to be a traditional short seller. And the list goes on. Hindenburg Research was a notorious short seller. In January of 2025, they shut down their fund. And I think it speaks to, as Carson spoke, the markets have become very much controlled by policy versus good old-fashioned market discovery. And we can go on and wax poetic about how right or wrong that is, but it's the reality. And in many short sellers and many fables of short selling successes happened in an era way before things like quantitative easing were even a talking point, never mind a fixture in the central bank's toolkit. So it is a different environment, and it is, we think, a key reason why, despite the tremendously high valuations that we and others have been talking about for a long time, it hasn't mattered yet. We don't think it doesn't mean they won't matter. It just means this extend and pretend has been elongated for longer than normal market forces would probably allow for. So in that sense, we can kind of relate to a Carson share because, if it were purely due to valuations in the U.S. stock market, we could make a case to be essentially out of the U.S. stock market altogether. Yet we're not, and nor have we been. We are underweight stocks, and where we are invested in the stock market, we are picking certain sectors and avoiding other sectors based upon our systematic tools. And we have not an insignificant intentional allocation to non-U.S. stocks, both emerging and developed markets, in part because they're actually quite on a momentum and relative strength basis, have exerted themselves quite nicely. But they're also at much kinder valuations than the U.S. market. So a lot of what he talks about as being a frustration for him as a short seller, we can relate to as just a prudent manager of funds for everyday people. And I'll just say, short selling is we've talked a lot, and I'm sure we're going to cover at length here today. Silver and gold and precious metals have done phenomenally well. But as much as we celebrate, and folks will celebrate reading the headlines, there are times where that investment has been frustrating. You go back over the last decade, there were some times you had to be a faithful, convicted believer that there was a true fundamental play here, and it paid back all at once, so to speak. And that's the way short selling works, not just once in a while, but all the time. True short selling is you have to have the patience of Job, and you have to have the liquidity and the funds to hang in there until the big payoffs happen. And most people don't have the composition to do that, nor do most everyday people have the financial ability to do that, because they need their retirement savings to create that paycheck that they need to live on. So those are a couple big takeaways. I want to talk about, he alluded to and he references Mike Green a lot, who we obviously have followed and understand his take on the passive bid that has underlied these relentless markets, if you could use that word. What stops his train? I think we agree with a lot of the same things he talked about. Just even on the margin, a slowdown in the pace at savings in kind of retirement plans, for example, or even worse, or God forbid we have a recession, which we have little doubt we will have one. They're not banned from the future of humankind. We have little doubt about that, and it just takes on the margin a shift towards more conservative positioning, or starting to sell down to fund retirement, taking out hardship loans and things like that. If you look at some of the data, there's been a modest but trending upward trend in things like hardship withdrawals from 401ks. It'll matter probably in an instant, so to speak. So I wouldn't take this and like Carson, we don't fret every night the imminent collapse. We think there's ultimately a very large reset in the stock market, but right here now, we're not worried about it being imminent. But I wouldn't want folks to take that to mean you shouldn't be concerned, especially folks that are inclined to just be passively invested. That is, we think, going to be a recipe for very big disappointment, if not financial disaster for real people, if they just tune out for the next decade. So I'll stop there. Those are some big picture takeaways.
Okay, no, I think those are great. Let me pull on a few of those strings. So as I mentioned to Carson, a lot of people watching the video right now, they may intellectually understand that if and when we have that big correction, a corrective event, John, that the central planner reaction function might be swift, right? But as I was talking about with Carson, there's a period in between when the pain happens and when the response happens, and then you get the benefit of the response. And a lot of people here don't want to be collateral damage of that interim period, right? They don't want to necessarily look down, at their statement and see that they're down 40% or whatever, right? Mm-hmm. And there's no guarantee that the rescue is going to bring asset prices right back to where they were before, right? I mean, that would be the intent of the rescuers, but it might not happen, right? So, the big question is okay, so how do you navigate this such that you are, getting everything you need in terms of the income off of your portfolio, if that's what you're living on in your retirement, or just the capital appreciation that you need because you still have a decade or more until when you're going to retire. But have some downside protection in case that corrective event happens, during that period of time. That's kind of where you guys live right now as capital managers for your clients. So just do me a favor, just summarize real quickly kind of the New Harbor approach to that, because you're not hiding in the bunker, right? But you're not blindly long either.
Yeah, I'll just start with where we're currently positioned. We're about 47.5% in equities, traditional equities. Nearly approaching half of that now is in non-US equities. Okay. We also have about another 10% in gold mining equities. We've always thought of those as different than traditional equities, but if you add that in, we're close to 60% equities. But we for a long time have thought of gold mining stocks as different stocks. So you might as well say we're underweight a traditional 60-40 stock portfolio. But even within that, I'd say there is refuge to be had, and there has been in non-US stocks in certain geographies, like we have done so. So you can, again, some of the valuations that we have long kind of fretted in the US markets aren't so extreme in non-US markets. In fact, all you need to do is look at a chart of those markets going back to 2008, and they're not much up from there versus you look at the S&P 500, and it's like, 2008 looks like a little speed bump way in the past. I mean, that's a very simplistic way to look at the relative, valuation differential. But it starts with, well, I'm going to get philosophical. First of all, it starts with one's ability to sleep. There are plenty of our clients who've worked really hard, sacrificed, and created a stable situation. And being at peace with that, their biggest risk, should be not missing out on, the last gasp stages of a market that's way out over its skis, but in unwittingly suffering a decline that forces them to try to have to do a do-over, which they don't have the privilege of doing. Now, that requires an emotional toolkit more than an investment toolkit, one that is able to be okay, not winning in every last point, so to speak, right? And everybody has to, and we do a lot of work with our clients, helping them find their own piece of where that is, right? Calling their own top, so to speak, and being okay if their family members or their neighbors are boasting more loudly at certain events, if things are getting more frothy than they're fully enjoying. That's okay. Coming to terms with that form of regret is a very important investment skill. But getting to the toolkit, the investment toolkit, having a systematic approach to scale up and down risk as the markets speak to us, not in what the valuations say, but we look at a broad array of breadth and momentum indicators, and sometimes that just has to be listened to. And sometimes it's at the market level or at the sector level. We have long, as I think we talked about last week, we have long felt the energy sector had been left out of the party and had been, from a valuation standpoint, relatively quite compelling. But it lagged even despite that until like late last quarter, let's call it, of last year. And we saw some technical improvement there, and some of the systematic indicators saying, hey, this is a place that's not only attractively valued, but it's actually now got the wind at its back, so to speak. And it's important to have a rules-based, emotionless kind of guide to help navigate what will likely be very volatile markets, and going in places that right now, as bullish as we are as precious metals. I mean, base metals are actually quite attractive. They've been performing very well. Too, yeah. And we have some exposure to that, intentional exposure on an international level. We just saw a chart today in our investment chatter that, looked at the cost for major copper mines, and almost every last one, where current prices of copper are, imply very large margins relative to the cost. So I would not be surprised to see that sector. It probably won't be as explosive up like precious metals have been and are notorious for being, but there are lots of places to find value and opportunity, even despite this policy-driven, distorted market that we all have talked about.
Okay. All right, Mike, I'm going to come over to you. First, you want to add anything to what John said, and then I want to talk with you about the action in the precious metals because it's been fast and furious.
Yeah, no, I think John covered it really well. I think that maybe one thing I'd say is like, is that there's I think a lot of agreement in the notes that I've taken, and you guys talked about gold and junior miners. One positive um, that Carson talked about was that there's a macro tailwind because of what central bankers have been doing. They basically buy every dip. And that's bullish for gold. That's bullish for real assets. The world seems to know that the ultimate answer is just going to be more printing. When you have some of the things that have gone on lately, like criminal kind of charges against the Fed for not dropping interest rates faster, um, that's not a safe environment for investors if the central banks are not completely independent. And so on that news, the metals took off. And so we completely agree with that part. We'll talk about that in a little bit in a minute, but other than that, I don't really have too much else to add. I think you guys covered it pretty well.
Okay. All right. Well, look, let's talk about the precious metals. So we're recording this on Wednesday. I don't think this video is going to run until the weekend. So who knows where the precious metals are going to be when this video airs, Mike, because just every time I look, they get higher and higher and higher. I was watching last night as I think the price of silver went into, zoomed up to high 80s, broke into the 90s. As of this morning, silver futures opened around 92 an ounce. I think they've come off just a little bit since then, but pretty crazy, Mike, to be sitting here talking with you about $90 an ounce silver, especially when a year ago it was like 28 bucks an ounce. And you and I were bullish on where it was going to go. We thought it could have a breakout opportunity. I'm going to say neither you nor I thought it would go this far, this fast. Once we're up here above 90 bucks an ounce, the tractor pull of the big round number of $100 an ounce silver starts getting into investors' minds. And usually that helps kind of pull prices to that big psychological goal that folks want it to get to. So you tell me, what are you expecting here in terms of the momentum of the precious metals here? They are so stretched from their moving averages that there's a real danger of a snapback to those averages. But at the same time, they got a hell of a lot of momentum and they've got that big round number now trying to pull them towards it. So what do you think?
Well, let's look at some charts. It's difficult at times like this to stay unemotional. Part of our job at New Harbor is to help people not feel emotional, or certainly not to act emotionally. Charts don't tell everything. They can only tell you where we've come from. You can make a guess as to where we're going because of them, but certainly you can take a look at them and tell when things are getting extreme. And all I can say is that when things are getting extreme, particularly when they're extreme in your favor and all of your goals are getting met and then some, that's not a time to be greedy. That's a time to start thinking about doing something, taking something off the table. Let me just share a chart here, a couple charts. I'll start with the silver chart that we always look at. And you should be able to see it now.
Yep.
Actually, I'm just going to have to zoom out a little bit. All right, so you should be able to see that. So this is the daily chart of SLV, which is the ETF that tracks silver. You're absolutely right. We're almost at 90. Spot silver is about, I don't know, $6, $7 higher than this ETF. But this chart gives you a pretty good idea of what the shape is. So we've had nothing but gaps here lately. Gap, 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 gap. Like 5 gaps in a row. The market's getting exuberant. One thing I've learned in my career is be careful about shorting parabolic markets. You never know where the top's going to be. So I certainly wouldn't short this. But
But you also have the axiom that gaps ultimately get filled too, right?
almost always they get filled. And so we don't know if we're going to go higher and then fill these gaps. This is on the daily chart. And at the same time, we have the CME hiking margins. We just had another hike, I think, yesterday. This time it hasn't done a thing, right? So there's a lot of reasons why silver should keep going up, and gold. We're big bulls on real assets. We're very negative on central banking. We think the world is finally coming to the realization that this game isn't going to go on forever. I think that's probably what we're seeing. But even with all that in mind, things are getting really, really hot in here, So just bear that in mind. This light blue line is the 20-day, 21-day moving average. At a minimum, we should touch that at some point. This move has been so strong that we've gotten close to touching it, but then we've just taken off again. We haven't seen the 50-day in a long time. Now, I wouldn't wait around to touch the 50. All I can say is this. This is more and more and more parabolic, and in the last week or so, it's very vertical. We should expect some kind of correction relatively imminently. Would I bet on it? No, I would not. I would not short this betting on that. But if you have positions in metals that have doubled, tripled, or quadrupled, sell a little something and do something with the money. Do the home renovation, the kitchen, the dream trip, buy the RV, whatever it is. Take it off the table and make it real in your life. That's what we've been coaching people to do because they have so much. Some of these people that have bought back at 15 or 10 have nearly 10x their money. And so it's very easy to be all in. All in thinking is not going to be very helpful psychologically and or in terms of enjoyment in life because if you're all in, you never sell any. And a lot of people are like that. They just want to sit on it and watch it go up and up and up because it's fun. And you're never going to know when the top is. So, but now would be a good time to sell 5, 10%, 15%, something like that if you haven't sold already. That's all I'm saying. So, we're just, who knows? We got the round level of 100 coming up. I should show you the gold silver ratio here on the left-hand side. 50, 52 now. It was 103.
Yeah.
And we were talking about that back in April, Liberation
That has
Day.
halved. Yeah.
Yeah. So long-term average is around 40 to 60. I mean, some people will say the long-term, thousands of years average is 15. And I guess I can't disagree, but I can tell you over the last few decades, it's 40 to 60. So it has normalized. There's no longer a screaming undervaluation for silver. Why are silver miners underperforming? I have no idea. And take a look at silver up today. It's up about $4 still. So take a look at that up there. I put in silver miners, SIL, they're down on the day.
Is that a signal, Mike?
I don't think it's anything. I think it's the market not believing the silver move.
That's what I'm saying. Is it a signal that the market doesn't believe that this silver metal move is sustainable?
I think that's probably what it's saying. There's a lot of hand wringing going on, I'll tell you that, on Twitter and elsewhere about why silver miners are underperforming. I happen to think it's an opportunity. I don't think it's a negative signal, if that's what you're asking. But the market is starting to think it's a negative signal. But if you take a look at SIL, it had a nice base breakout, and then it broke out of this flat base right here. It's all beautiful. It looks good. And it's still holding. One thing I can say is that we're all impatient, including me sometimes. We want instant gratification. Silver goes up, we want silver miners to go up 3x. It doesn't work like that in the real world. The market, I've learned this the hard way, the market rewards patience, not impatience. Here's the junior, same thing. We broke out, sideways action. The market, I think, is going to reward patience. If you're not overweighted here, don't worry about it. There's just, I believe there's more upside in the silver miners than in silver. GDX and GDXJ have done a little bit better, relatively speaking, but the shapes of all of these curves are relatively the same. So we were basically saying with silver way back at 30, 35, watch the big triple top breakout. I mean, maybe you can go to the weekly chart here. Down here, I still have the line there. 1, 2, 3 tops.
God,
This is
look
a
at
weekly
that
chart.
chart.
Look what's happened since then. I mean, 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. If I go to the monthly chart, 2, 3, 4, 5, 6, 7, 8, almost 9 months. Straight up. Look what happened back in 2011. This is strong, much stronger than the 2011 move. And what's different this time, not only is it more weeks, but it's more persistent. But at some point here, we're going to have a wicked red bar here, and it's going to go that way for a couple months. And then we're going to have to see what happens next. So that's all I'm saying to people. Don't get too in love with this. Sell a little bit on the way up because that'll give you staying power.
Okay. Mike, can you go to the miners chart, the GDX chart here? Because obviously at New Harbor, your position's more in the miners than the metals itself. And to John's point, you guys don't short, but you do purchase downside protection for your big positions through options. So where are your hedges right now on the miners?
Well, we have kind of a unique situation in that we have half of our miners hedged and they're in the money. So, right now on 50% of our position, we've taken in accumulated credits, but our strike on half of our position is 80, right? So we might be capped out. You'd have to add up all of our accumulated credits, but we might have accumulated credits of $6 or $7 or $8, something like that. Let's call it $7. So that means 80 plus 7 is where we would be capped out at 87 on half our position. So that means we missed out some upside on half of our position. That's okay. That's the
Okay.
cost of our insurance program.
So
And by
sorry,
the
Mike, was that covered calls then?
This is covered calls. We
Okay.
do not have puts in place right now.
Okay. So basically, okay, so you bought some covered calls to get some income, but you cap your upside. The risk is that the stock runs to the upside, which it did in this case.
That's right. It did. Put the line out of the way there. The stock ran up to the up. We had this, and this has really been going on many different cycles here. But at present, we've rolled up to 80 with accumulated credits, which I'm going to estimate are around 7. So that means we've got a covered call on 57%. I'm sorry, on 50% at $87 or so. And that goes out to February, the third Friday in February. Now, here's the thing. If we keep going up and up and up, we're going to keep enjoying the ride. Now, our rebalance position back down at like 60, we rebalanced to 10%. That model position is roughly, let's call it 14% now because of growth. And so I know we always say 10%, but that's for new clients. We haven't rebalanced in many months. And so our average client size is maybe 13 to 14%.
Okay.
Half of that is hedged at 80 plus the accumulated credit, so maybe 87. The other half is free to run. It's always a balance between dampening volatility and providing hedges and giving upside. I would expect at some point we're going to have a sharp pullback. We have a sharp pullback to the 21-day moving average or even the 50-day moving average down here. Well, guess what? The half that's unhedged does get a decline, but the half that is hedged has dollar for dollar offset because of the in the moneyness. So it works both ways. If we fly higher from here, we're going to ride the 7% that we have. If we tank from here or correct, we're going to very quickly get back to close to 14% automatically. So it's hard to visualize, I know, but that's how it works dynamically. And we're just trying to smooth out volatility.
All right. Well, really interesting times from here. So let me ask you real quick, Mike, do me a favor, just pull up the chart of gold for a moment.
Okay.
I was talking about the pull of the big round number when it comes to silver, right, with $100 an ounce silver. Gold is trading now above 4,600 an ounce. Is that starting to get close enough to the big round number of $5,000 an ounce that Wall Street starts thinking about that, and the tractor pull of the mental desire to get there starts kicking in?
Yeah, let me show this chart here. This is GLD. Just don't have futures quotes on this platform we're using right here. So, we're 4,600. So just imagine that. This is 424. It's about, 400 points above that. So would be 4,240, but another 400. So this gives you a good idea of the shape of the curve, not the exact spot price. So you're right. We're getting close to 5,000. Gold, 100 silver. I've got no doubt we're going to get there. I just don't know that we're going to get there now. That's the big question. I mean, if I go back into the longer term charts in these things, and here's gold, triangle, sideways breakout, triangle, kind of up, and then consolidation breakout again. But these things are getting late stage. Here's a base, here's a base, here's a base, and a breakout three times in a row here. The first time the whole world is kind of sleeping. The second time, half the players start to take notice. The third time, everyone notices, So I don't know. I think it might be exactly what the market often does is it gets close to a number and then it just slaps you in the hand, and has a big correction. But I think a year from now or more, we'll be above 5,000 gold and 100 silver. There's a lot of people all over the internet saying they think we're going to be there now. And to be honest, I wouldn't be shocked if we get there really quickly. But it's a super bullish chart. It's getting close. I don't know. Your guess is as good as mine, Adam. I'd still be ringing the register a little bit if I had a big position.
Yeah, no, well, I mean, I totally agree that, either position rebalance, which we talk about doing all the time, or if you've got ounces that you just don't want to sell, then hedge, right? And it's funny, I get so much pushback against this because, the metal's been running so hot. People have been saying, well, this is why you don't want to hedge. And it's like, well, yeah, I mean, hedging is never sexy when prices are going up.
Well, that's
It's
right.
only sexy when the price action stops and then people all of a sudden really wish they had insurance in place. Um, Personally, one man's opinion, so this is definitely not financial advice. I wouldn't be surprised, Mike, to see $100 an ounce silver. I think it's probably more likely given how close we are, but also $5,000 gold. I wouldn't be surprised to see those in the relatively near future. For me, the bigger question I have is just how long will those prices sustain? Do we touch them and then have a big pullback and some long period of time of trying to work through all the froth before they start going higher again? Or, is it really truly a brand new price regime and, those become the new floors? I don't know. Totally TBD.
Well, we'll see. Just remember, we get these calls all the time for hedging. It's very expensive to hedge with puts. All right, so you really want to be selling covered calls if you can. If you happen to own gold in the form of GLD, you can sell covered calls, or you just want to be selling on the way up. I can give you a really quick example here. If I look at GLD and I go out to 1 year from now, you probably can't see this on the screen because it's so small, but the current price is like 425. And let's just see what it would cost to buy a put. If I bought an at the money put, 425, it'll cost me $29 a share. 29 divided by 424 is like what, 6% maybe? That's not horrible. I mean, I guess if you want to pay 6% of your pile, we can basically say you're not gonna, no matter what, you're gonna be able to offset the downside, but that gets pretty expensive over time, so it's much better to sell some covered calls and take in some income or just sell on the way up.
All right. Well, look, wise advice as always, Mike. So we'll wrap it up there, just given where we are time-wise. John, I'll punt it back to you for closing remarks here. For much of the past 2 months, we had been advising people, hey, you know, don't procrastinate in taking care of whatever end of year deadlines you're going to need to meet, whether it was minimum required distributions or charitable donations or whatever. Okay, so we're past year end now. Now that we're here at the beginning of a new year, do you have any advice for people in terms of things they should be doing now or considering now to set themselves up well for the full year that we have ahead of us?
Well, yeah, I mean, a lot of last year was about, hey, how do we kind of minimize, realize most people especially people that just sat there and did nothing even, had a pretty good year and maybe even better year than they imagined they would. And with those gains comes the possibility of capital gains taxes. So we certainly did all we could to mitigate how much realized capital gains our clients booked last year and therefore owe taxes on. And we did a pretty good job. We talked about our hedging strategy with the miners. One of the silver linings there, excuse the pun, is we were able to do, in doing those call rollouts and roll-ups, we were able to harvest some losses on the way doing that. So it's kind of like we got to keep the stock, still appreciate some upside, gave away some upside, but also harvested some losses in those calls. But now that we're in a new tax year, this may very well, especially if you have an outlook like we do, that eventually we'll probably see some real downside in this market, and very likely this year at some point. By all means, think about taking some gains. Ideally, if they're long-term capital gains, you've held them longer than a year, you're going to get taxed at a favorable rate relative to most people's short-term capital gains tax rate. So think about that. And no better place to think about than the metals, like we talked about. Selling some winners here and right sizing positions is probably the most important thing someone can do, even in a strong sector, because if they're overweighted, it becomes unhelpful to the situation because nothing goes up forever, not even precious metals. So that's that. I'm looking. I'm actually looking at some questions. We actually have a live Q&A. We do live Q&As for our clients every month, and we have one tomorrow. And in fact, Adam, if you'll indulge us, we'll we do get a lot of prospective clients that join in these as well. Certainly, your viewers, if they wanted to tune in, they could find our live Q&A. I think have it advertised on our LinkedIn page and perhaps even Twitter. But we got a lot of questions. A lot of the questions have to do with inflation, precious metals. Is it too late to get in? Should we sell some? Taxes. I'm just looking at the other things here. Psychological aspects of money. So we have a pretty far-ranging, roster of questions that almost is like a day in the life of the kind of work we do with clients. And I invite your viewers certainly to come join us, submit questions in advance or live during the broadcast. But happy to kind of answer any questions anybody has. But
Great.
these are the real everyday things we help our clients with. And
So John, sorry, when is that Q&A?
that's tomorrow. Sorry, I should have given you the.
Yeah, so just
It's
FYI, this video is going to be released after that day. But
shoot.
hopefully folks can catch the next one that you guys do.
Well, we do them every month. So every month, and I apologize for the goof up on the calendar there. Yeah, but we usually do them on kind of first or second week of the month, and usually 2 p.m. Eastern for an hour or so. And love to have people tune in.
Great. All right, just in wrapping up this topic, so you mentioned capital gains, John, and I just want to give folks a quick refresher. So when you have capital gains in a financial asset, there are two types of capital gains taxes that can come into play. One that definitely will is the federal capital gains, and those range from 0% capital gains tax to 20% on your long-term gains. So I'm sorry, let me step back for a second. Two types of capital gains, short-term and long-term. Generally, if you've held the asset for less than a year, it's going to be taxed at a short-term capital gains rate, which essentially is going to be what it taxed as income to you. So whatever your marginal income tax rate is going to be, your short-term capital gains are going to get taxed at that. If you've held them for over a year, they'll be taxed as long-term capital gains. And there are three types of federal long-term capital gains tax rates, and they depend upon what your taxable income is. And you'll see here right now, this tax schedule here, but basically it's 0% below a certain threshold. Above a certain threshold, it's 20. And if you're somewhere in the middle, they'll be taxed at 15%. So that's what the federal government's going to tax you at. And then if you, depending upon what state you live in, you'll pay state capital gains tax if your state taxes capital gains. Not all states do. So like the state I live in, Nevada, doesn't tax capital gains. It's one of the reasons why I moved here. But primarily it was because it doesn't have income tax in Nevada, which is the bigger deal for me. But the way in which these capital gains are taxed by state differs. So, for example, if you live in California, which is the state I lived in, no matter whether it was a long-term gain or a short-term gain, they're going to tax it at your top marginal income rate. Again, this all differs state by state, so obviously check with your CPA or whatever. But guys, I just wanted to share that because I think for a lot of people, they kind of know they have to pay capital gains, but they don't really necessarily understand all the math that comes into play. But those are the factors.
Adam, glad that you highlighted that. And just like you did, I'll reiterate, this is not personalized tax advice because it gets down to very specific things. But other things you got to be careful about there is not unsuspectingly invite other issues. Like there's a rule called IRMA, basically, and I forget what it stands for. It's an abbreviation, but capital gains realized adds to income. So in respective calculated Social Security taxation and Medicare surcharges, things like that. So you want to be careful that you don't lose sight of some of these other tax-related stuff and get an unexpected surprise there.
Right, and again, I'm not a tax advisor, so obviously go speak with yours. But I am guessing too, John, as well, that if you are taking on capital gains that are taxed as income, it could potentially, if you have a big enough capital gain, it could bump you up into the next marginal
Oh,
tax
absolutely.
bracket, right?
Yep. Absolutely. Absolutely can.
Yeah.
And one thing you didn't mention, Adam, that we talk with clients about too, again with the caveat that we're not tax experts, is the NIIT, a tricky little tax called the net investment income tax. So here's a little tricky one. I'll just show you right on the IRS's website. If you have income from investments, you might be subject to this. If your modified adjusted gross income exceeds 250K if you're married, 200K if you're single, and MIGI, by the way, Maggie, includes interest, dividends, capital gains, etc. So even if you have, let's say, $100,000 income, but you take a $200,000 capital gain, that chart you just showed shows that if you're under 545, I think it is for a married couple, you're going to pay 15%. But guess what? You're also going to pay 3.8% NIIT. So it's a little tricky, but it's just an additional tax people should know about. And if you can avoid it by staying under those limits, I'd say avoid it.
Okay. So I think to the spirit of my original question to you, John, um, I think maybe a really good thing that most folks should consider doing at the beginning of a year is revisiting their financial plan, right?
Absolutely.
Let me update the financial plan. Let me, what's changed over the past year of my life? Have my forward expectations changed at all? Let me get my financial plan up to date so I know where it's going. But then you can use that to kind of come up with your income projections for the year and whatnot. And then you can, that can then really inform you for having some discussions with your tax advisor about, okay, how can we make sure I don't trigger some of these other additional taxes I might be subject to this year if I do things differently from the start? So obviously you guys do a lot of financial planning for clients, correct?
Absolutely, we do, Adam. It's part of the package.
Part of the package. All right, folks. Well, look, highly recommend you set yourself up for success this year by doing a lot of the things we just mentioned there. If you do them on your own as a DIY investor, great. If you have a financial advisor who can do all that for you, great. But if you don't, or you'd like some help from one of the financial advisory firms that Thoughtful Money endorses, maybe you might even want to talk to John and Mike and their team there at New Harbor Financial. Highly recommend you just take this action. So anyways, a really good first step to that could be, again, if you don't have a good advisor already advising you, talk to one of these guys that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. The consultations you'll have subsequent to that are totally free. There's no commitments involved. Either it's just a service these firms offer to be as helpful to as many people as possible. But the key thing is just make sure you're setting yourself up for the greatest chances for success at the beginning of the year for the full year. Also, folks, if you'd like to see Carson come back on this channel again at some point this year, please let them know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it if you haven't clicked that already. Just in talking about the precious metals, just a reminder that the special offer, the exclusive offer that Andy Schekman, CEO of Miles Franklin, has offered to the Thoughtful Money audience for buying junk silver for just $1.35 over spot. Supplies are still lasting on that for the time being. So if that's something you might want to take advantage of, just fill out the very short form at thoughtfulmoney.com/buygold, and Andy and his team will be in touch with you right away. And not only can you talk to them about the junk silver offer, but if you've got additional questions about buying, storing, or selling precious metals, they can help you with all that as well. John and Mike, thanks again for yet another great week. New Year's off to a strong start. Thanks for being with me here. Look forward to doing this with you all through the rest of the year. And very much appreciate all the help that you guys have done for all the many people that the Thoughtful Money channel has sent your way. I get a constant stream of folks saying how much they appreciate the service that you guys and your team provide them. So just want to say thanks so much for your partnership.
Thanks to you, Adam, as well, and your viewers. Thank you very much.
Thank you, Adam. Always a pleasure. Thank you for those kind words. We're privileged to be able to do what we do, and thank you and all the folks that have reached out to us through Thoughtful Money.
All right. Well, thanks so much. I got a lot of travel coming up in the next week or two, but I think we'll still be on the schedule here. So look forward to having you guys here next week. But yeah, I'm going to Houston and then I'm going to Vancouver, all for conferences. But somewhere, somehow on that road, we'll get together and record next week so folks can hear your latest update. Thanks so much again, boys. Really appreciate you being on this journey with us. Everybody else, thanks so much for watching.
Gold is becoming more expensive. It is the dollar which is losing its purchasing power versus gold. The price has been steadily moving upward over the last 2 years. And it surges it breaks out, it surges 15%, it consolidates for another 3-4 months, breaks out, surges 15, 20%, consolidates for 3 or 4 months. This has happened 3 or 4 times now. And as most people know, it's been consolidated under 3,500 since about April or May. It's now broken out, and I think there's a rush of speculative interest because another 15%, if we keep the pattern going, takes us up to about $4,000 an ounce. I think the next move in this current move is probably to 43.5, 44. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through.
Gold's rise isn't about it becoming more expensive. It's the dollar steadily losing value against it. For the past 2 years, gold has followed a pattern of breaking out, surging 15 to 20%, then consolidating for a few months before repeating the cycle. After holding under $3,500 since spring, it has now broken higher, and if the trend continues, the next leg could carry it toward $4,000 an ounce. Silver, meanwhile, looks set for a move toward $43 to $44 in the near term, and with expected rate cuts and yield curve control ahead, next year could be when it finally breaks through the long-standing $50 barrier. Craig Hemke is a longtime precious metals analyst and founder of the website TF Metals Report. He recalls that back in 2011, silver's sharp run from $38 to $48 in just 4 weeks wasn't a bubble, but the result of a commercial short squeeze. Speculators were long while commercials were heavily short, and when shorts had to cover, prices exploded. If commercials pile on new shorts, silver will likely grind higher in a slow, stair-step move. But if they start covering without heavy speculative buying yet, that could trigger a breakout, drawing in new money and creating a powerful rally. Silver tends to sit quietly for long stretches, but once momentum builds, FOMO quickly takes hold. The current move may aim for $43 to $44 before pulling back, but next year, with rate cuts and yield curve control likely, it could be the time silver finally smashes through $50. If it does, tests that level as support, and holds above it, then the market could truly take off. If silver breaks above $50, the real stress will likely show in London's physical market, not comics. With supply deficits, limited float, and heavy reliance on paper ETF instead of real bullion, a surge in demand could expose shortages and trigger major volatility. That's when silver could truly get spicy. As we play Craig Hemp's video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
Crazy breakout camp just yet. I think it's an important time for people to be paying attention to what's going on internally with silver. In April of 2011, okay, so most people remember that, price went from 38 to 48 in about 4 weeks of that month, over the course of the month. And it was assumed, it was written up, and people look back, with revisionist history and make it sound like it was a big speculative bubble. What was actually going on, if you followed the Commitment of Traders report back then, was a commercial short squeeze. They had all these speculators that are long, all these commercials that are short, and they started having to cover shorts for, without going into all the details as to who was short and why and all that stuff. But you could just see it on the Commitment of Traders reports. And that's what took it from 38 to 48. I think, could we have a similar month now? Of course. But we want to be watching those Commitment of Traders reports because it'll tell you a lot. If the commercial side of that equation is aggressively adding new shorts this month, okay, well, we're just in that kind of stair-step phase, of 2 steps forward and 1 step back. But if we start seeing a lot of commercial short covering without a lot of new speculative money yet, and that's what drives us, well, then, when we get that breakout of, top of the cup, then you get this big rush of speculative money that just catapults you further. Because silver's a lot like, and I'm sure I've used this metaphor before, it's like Newton's law of inertia or motion or whatever it is. I took physics, but it was a long time ago. An object at rest remains at rest until a force is applied to it, right? Just sit there. My computer right here, but if I push it, okay, all right, it'll remain at rest until a force. And that's kind of what silver's like. Silver just sit there, as we all know, and just do jack for a long period of time, even like not keeping up with gold because people are waiting. You're like, well, I'm not going to get involved in silver yet because it's just sitting there doing nothing. But then as it starts to get moving, then you get this kind of FOMO thing. Hey, we've seen this before. And so what will probably happen, I would not expect it to smash through the $48 to $50 all-time highs in the first try. That's generally not how it works. And so I wouldn't think we would get there this year. You go up. We could go to, I think the next move in this current move is probably to 43.5, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through. You go up, tap it, find resistance, finally break through, everybody goes crazy, and then it pulls back, tests that old resistance level for support. And if it finds the support and you stay above 50 and then start making new highs after that, well then, holy Toledo, then we could have some fun. And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? The supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered, how many times supporting the derivative markets, all that stuff. If we set off on this, break through 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, they don't want to deliver theirs out or whatever, things could really get spicy next year. I saw that stuff too last week. There were 9,000... I can't remember, 9,900 or something, COMEX September silver contracts that were open and standing for delivery when that contract went off the board. And then it gets delivered against, you got to be 100% margin long covered so that you can take delivery if that, you're long and somebody the short puts the silver to you. And, historically, that's a lot. But back in March and May, we were doing 18,000 contracts. Okay, so it's not like, oh, wow, it's 10,000 in September, the system. No, it's not. No, not yet, at least. Okay, but it is a not insignificant amount. If we've already delivered almost all of those, that's 50 million ounces. I don't know if it ever actually leaves the COMEX or if it's still just this, oh, this month I'll take delivery, next month you take delivery stuff. So we'll keep an eye on that. I don't think that's where the stress is. To me, after kind of getting excited about that 15 years ago, I don't think that it's the COMEX where you'll see delivery stress. It's more likely in London. I'll give you this. I mean, you've seen over the years, Elijah, and I'm sure everybody listening has seen this, we're like Stan Druckenmiller or Ray Dalio or, whomever, some big hedge fund manager. They'll say, we want to own gold. And you're like, good. And then they buy the GLD, right? And you're like, well, what good is that? I mean, that gives you price exposure, but you don't really, you can't take delivery, Stan. You can't take delivery.
Craig Hemke explains that the dollar index is misleading, as it only compares the dollar to other weakening fiat currencies. While it appears stable, all major currencies are losing purchasing power together. Recently, talk of yield curve control has quickly gone mainstream, signaling that central banks may soon cap long-term rates to contain debt costs. The U.S. looks set to follow this path, echoing past strategies to manage high debt. If that happens, it would echo what the U.S. did after World War II, when debt to GDP ratios were similar. Back then, the Fed and Treasury worked together to hold rates down, effectively inflating away the debt with cheaper dollars in the future. We could see something similar soon, especially if Fed leadership changes. This would likely require massive new quantitative easing, with central banks buying and monetizing their own debt in a move resembling modern monetary theory. Such a shift would push real interest rates deep into negative territory, and that's extraordinarily bullish for gold and other precious metals as fiat currencies are steadily devalued.
The deception of the dollar index, because it just compares the US dollar versus all this other equally worthless fiat, right? And so the dollar over time, you pull up a 30-year price chart of the dollar index, and it's 100, and it goes up to 120 and down to 80, and it just stays basically the same. Well, that's because all the other fiat currencies are devaluing at the same rate. But I said, expect more rate cuts than what people are thinking are coming. And furthermore, don't be surprised if by December, the December FOMC meeting, the Fed isn't openly talking about yield curve control. And I mean, I wrote that like on New Year's Eve last year. There was nobody talking about yield curve control. But now, all of a sudden, here in late August, early September, it's like, oh yeah, yield curve control is coming, like everybody was predicting this 8 months ago. Yield curve control is coming. Whether it's globally, if all these central banks have to do that to control the long end of their curve, right, and control their interest costs. But I think you're definitely being told and warned that it's coming here in the U.S. And I think that's all part of what's driving gold too, because that would be extremely bullish news for gold. You'd be holding real interest rates sharply negative. I mean, the U.S. has done this before, which is why I wrote about it in my pod. I even put a link in there in that macrocast, because coming out of World War II, when we had similar debt to GDP ratios, that's what they did. They kind of combined the Fed and the Treasury together. They did yield curve control, essentially to pay off the debts of yesterday with the cheaper money of tomorrow, right? Get it under control, grow your way out of it, which is what Besant keeps talking about now. Well, anyway, if you want to take the time, to connect the dots, I think they're telling you that's what's coming as soon as next year, once Powell gets replaced and everything else. And so if that's the case, they're going to be trying to cap the long end. It's going to involve a lot of new quantitative easing measures, central banks buying their own debt, monetizing, almost like a modern monetary theory move. Again, all of this is extraordinarily bullish for the precious metals in terms of devaluing the existing fiat currency.
Both gold and silver are flashing signals of major shifts ahead, fueled by monetary policy, debt dynamics, and the growing disconnect between paper markets and physical supply. If central banks resort to yield curve control and deeper monetary easing, precious metals could enter a new era of explosive gains, marking a turning point for investors who have been patiently watching these markets build momentum. Do you think central banks will be forced into yield curve control sooner rather than later? If silver finally breaks above $50, will physical shortages in London expose the true limits of supply? Leave a comment below with your opinions. We would be delighted to hear from you. Please remember to subscribe for more material, and give this video a thumbs up if you found it useful. We appreciate you joining us on this adventure.
And with physical market liquidity now setting the global gold price, the Fed will have to fold its short derivative hand and as quickly as possible get on board the upcoming gold revaluation. Is at a position where it's got to short cover. And it's going to have to follow what the BIS did. And then figuring that most likely that the December contract, this is spot here, but this contract, which just launched, which was the December contract, and this reflects that COMEX liquidity, is very likely going to have to move in. It'll move into first notice on the 27th of November, and delivery commences on the 28th of November. So this contract doesn't expire until November. So that'll be right around this point here. Well, we suspect that the price is going to be much more reflective of our spot 4,500 target.
With physical market liquidity now driving the global gold price, the Fed has little choice but to abandon its short derivative positions and prepare for the coming gold revaluation. Like the BIS before it, the Fed will be forced to cover its shorts. The attention is now on the December COMEX gold contract, which just launched. Liquidity is expected to shift heavily into this contract as it approaches key dates, first notice on November 27th and deliveries beginning November 28th. While the contract doesn't expire until later, the crucial activity will happen around that period. By then, gold prices are likely to align more closely with the physical market, with projections pointing toward the $4,500 target. Andrew Maguire, a London-based precious metals trader and whistleblower, points out that Chinese pension funds have been directed to raise their gold allocations from just 1% of their $2 trillion assets. At the start of the mandate, gold was around $2,700, but prices have since climbed close to $3,500. Analysts expect this shift could add 1,000 tons of new demand by 2026, nearly a third of annual global supply. India may follow, with regulators considering allowing its $177 billion pension system to buy gold ETFs, adding further demand. This trend reflects a broader BRICS strategy of moving away from U.S. Treasuries into gold after the BIS reclassified gold as a top-tier liquid asset in 2023. At the same time, unreported central bank gold buying is far higher than official data shows, with liquidity providers estimating hidden demand close to 42,000 tons. This accumulation, alongside de-dollarization and treasury-to-gold swaps, is tightening supply while fueling safe haven flows. The U.S., with its limited and heavily rehypothecated reserves, is falling behind. Analysts argue that rising bond yields could soon force yield curve control, driving even more gold demand. All signals point toward an inevitable forced gold revaluation, with conservative year-end price targets set at $4,500 per ounce. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below.
More Chinese pension funds are being mandated to increase their original 1% of their $2 trillion of assets into gold by the end of 2025. Now, they're definitely, that feedback is very reliable. And at the inception of the mandate, gold was trading at about $2,700, equating to about 8 million ounces at the time. That was about 250 tons. Of a 3,000 ton supply. Since this directive, gold's risen by close to $900 an ounce at 3,500. Now, while this timeline has yet to be revealed, now given the current escalating BRICS trade war leading into military escalations, an additional 1,000 tons, or 1/3 of all global supply, could be demanded by the end of 2026. This feedback has been rock solid reliable, and we expect this to be announced at some point. Also, India's market regulator is considering allowing the country's 177 billion pension system to also buy gold ETFs, a move that could drain an additional 17 tons of new demand, just simply a 1% allocation. Now, this follows the Bank of India switching gears, converting US Treasuries into gold directly after the BIS had recategorized FX gold as a first-year high-quality liquid asset on the 1st of January 2023, and is representative of what is also empirically evident across the entire BRICS sphere. Also, sovereign borrowers swapping out of dollar debt into lower Chinese and Swiss interest rates. Asian and Middle Eastern investors are avoiding exposure to the US. Also, it's filtered through to the Financial Times through Goldman's desk, picking up on some unreported central bank gold purchases. Our liquidity providers have been reporting they've been reporting this since Russia's assets were frozen in February 2022. I think a lot of people knew that this was happening, but I think what's interesting is that obviously we knew that physical gold buying had significantly accelerated when the Bank of Internationals squared all their remaining 500 tons of gold swaps. If you remember, that was on the 1st of November 2022. And that was just before the BIS revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023. So for reference, net of paper market dilution, when including direct doré bar imports that seemingly disappear into the 42 district Chinese customs districts, which feed into a 678 loco customs matrix. And we've talked about this before. So much is lost through this system. And we figure this is likely military gold that doesn't get reported. Then if we just base that purely on real global supply demand fundamentals, these same liquidity providers now estimate real unreported central bank monetary gold demand, not captured even in Goldman's assessment, is closer to 42,000 tons. This is not yet priced in, but it still marries with our end of year $4,500 target. Now, these swaps of US treasuries for gold cannot be, they're just, obviously the White House knows what's going on and they are following it. And so obviously after the bullish for gold, India, China, Russian SCO's summit, which is only just finished over the weekend, this will have severely ruffled the White House's feathers, driving another round of fresh safe haven gold and critical mineral silver demand at the expense of the dollar. In fact, directly pushing back against. Now, we're going to update more on these extremely bullish developments as they progress. But as the global central bank sovereign institutional de-dollarization, US Treasury to gold conversion process escalates, it's only a matter of time before the long bond yield rises above 5%, which is deemed as the inflection point that would likely trigger yield curve control, flooding the market with cheap money, which will be hedged with global central bank gold buying. With the US lagging global central bank gold buying and with only 8,100 odd tons of empirically rehypothecated US Treasury holdings, everything points to a cash-settled forced gold revaluation. With the LBMA CME now becoming price takers, buying back leased gold reserves will have to be conducted at market. Conservatively, this reaffirms our minimum target of 4,500 by the end of the year.
Andrew Maguire highlights that since January 2023, China, Russia, and other BRICS nations have been aggressively stockpiling physical silver for military, AI, and green energy needs. With the U.S. now classifying silver as a critical mineral, Washington has joined the race, restricting exports and pushing global sellers to hold out for higher physical prices. Technical charts show resistance around $44.27, with large commercial short positions forced to cover. Geopolitically, this has turned into a full-scale resource war. Andrew Maguire mentions that for years, Beijing quietly funneled Western silver into its vaults. But now with U.S. competition and sanctions looming, stealth is no longer needed. The U.S., starting with minimal reserves and a large naked short exposure through FX silver contracts, is vulnerable. Russia and China are well aware of these paper shortfalls and may use them to pressure the U.S., making a physical squeeze on silver supply almost inevitable. Let's recall the interview now.
On the 1st of January 2023, China, Russia, and BRICS nations began stocking up physical silver for military, AI, and green energy applications. Military being a big component of that. However, now that the US has recategorized silver as a critical mineral, what it's done is ignited a race by the US to also stockpile silver, severely limiting the sales of US silver in turn incentivizing global sellers to hold out for yet undetermined but significantly higher physically determined prices. Shane, here's the monthly target you referred to that we circled in our last episode, which was right here, and the price was way back here. And the end of the month, this is a monthly bar, the end of the month exactly fulfilled the August target. Now, while we expect $52, 53 in fact, or very close to 53, to be secured as the next higher stairstep to rally from, along the way, the next immediate target is 44,275. Now, this is a futures chart where we expect a fight here, but very large commercial short stops sit above this pivot. This is where a huge amount of shorts were added, and not all of them have been covered on anywhere close to getting covered on this rally. So you're going to see some resistance and you're going to see a fight, but once it's through, then really it's blue sky. And guess what? Beijing knows exactly where these stops are, here and here. Following Trump's unhelpful confrontational comments today, this is the Wednesday the 3rd, Russia, India, and China are targeting both gold and paper silver for conversion into physical. This fresh retail demand has not yet translated to the retail market, but it will, further tightening up the fifth consecutive 200 million ounce per annum supply shortfall, providing yet another catalyst to easily drive spot silver through all-time highs. With the US now competing to secure tight for supply physical silver, it's going to unsettle the SGE's stealthy 5-year privileged physical concentration position. Now the gloves have come off, and over the last 5 years, the SGE has successfully utilized control of its global position concentration, employing SGE physical to unallocated spot hedging mechanisms, which were structured to enable them to arbitrage the difference while at the same time containing the silver price, as it strategically was flowed into Beijing vaults. Guess where it was coming from? Or out of the West. So geopolitics, trade wars, and a direct frontal attack on competing BRICS nations declared Beijing no longer needs to be stealthy buyers. And with the CME LBMA open interest migrating out of Beijing's unallocated playpen, so they don't need to play this game, they have enough silver, the race to accumulate silver, along with all critical mineral assets, is underway, catching the US severely on the back foot. The US has come out of the gate with almost no silver reserves, which will mean they will heavily sanction or ban US silver exports, almost certainly. However, the Fed has accrued a very large naked short, unallocated, Office of the Comptroller listed FX silver position. It's the only place it shows up, which will now come into Russia and Beijing's crosshairs because they know about it too. So they know that that has to be short covered because there is no silver to back those positions up. And technically, FX silver should be deliverable.
Andrew Maguire emphasizes that both gold and silver markets are entering a historic turning point, driven by physical demand, de-dollarization, and escalating geopolitical competition. With central banks, pension funds, and sovereign wealth funds rapidly shifting into precious metals, the paper-based system looks increasingly unsustainable. If current trends hold, a forced revaluation of gold and a physical squeeze in silver may not just be likely but inevitable. How might a forced gold revaluation impact global financial stability and U.S. monetary policy? Could silver's role as both a critical industrial metal and a monetary asset make its supply squeeze even more severe than gold's? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.
Japanese yen is one of the worst performing currencies versus gold, which in my book is inflation. I mean, not that gold isn't breaking out already, but I think silver will accelerate. And like Phil said, for people who haven't bought gold, I guess silver will be the alternative.
For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like that, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock.
25th of September, the consultation period over whether silver should be a strategic mineral in the United States will finish. They'll have to start building a silver stockpile. And we don't know how big that stockpile will be. Obviously, in the past, it was 2.1 billion ton. If there's a disruption in the supply from Mexico, which is where they're getting most of their silver from.
One of the worst currencies in relation to gold has been the Japanese yen, underscoring the growing pressures of inflation. Silver is predicted to rise quickly as a substitute for gold for those who missed it, even if gold is already starting to break out. By September 25th, the United States must decide whether to designate silver as a strategic resource. The government would have to accumulate 2.1 billion ounces, which is almost 3 years' worth of mine supplies, if it were authorized. Since Mexico supplies a large portion of America's silver, any disruption there might have a significant effect on the U.S. sector. Experts estimate that there is a 4% chance of such a situation. Mario Ineco, a famous market strategist, and Phil Lowe, a sharp macroeconomic commentator, both highlight that since April, the Dow-to-gold ratio has fallen precipitously, and it currently exhibits trends reminiscent of those seen in 2007 before the financial catastrophe. Long-term charts indicate otherwise, despite some people's concerns that a liquidity event may put pressure on gold and miners. It's evident that the trend is strong because banks like Goldman Sachs are now predicting that gold will reach $4,000 by mid-2026, while silver targets are already almost reached. The wider breakthrough indicates that gold's bull market is well established, even in the face of possible short-term pullbacks. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
This one here is the Dow-gold ratio, and we dropped quite a bit in April when we had that beginning of April, and then it's being consolidated, and now it's breaking down, and it looks a little similar to this, and this was in '07 before the great financial crisis, but I mean, we'll have to see anyway.
One thing I may, because we were just discussing Weimar, I do want to stress that Weimar was a very unique situation because the Entente powers were not letting Germany default. They said, you cannot default, you have to give us gold. And that's what stretched Weimar out to 2 years. I want to reassure the viewers, like, I think this will be over in 3 to 6 months once it really gets going. It's going to be brutal. It'll be as brutal as Weimar, but it'll be a lot shorter.
Yeah, but in Weimar, it started taking off. The hyperinflation really picked up in the summer of 1922, and by the 1923 it was over. So it was about 18 months. And
I think this will be about 3 months. I think they'll once they start losing control of food prices, I think they'll revalue to gold.
Now, I thought commodities were going to start a bull market in the early 2020s, only because bonds, I thought were going to start a bear market, and I thought hard assets will benefit in relative terms. But we see now that banks like Goldman Sachs, who usually just push paper and derivatives, they're actually telling their clients to diversify into commodities. And they even, I think they said that they expect gold well above 4,000 by mid-2026 if the Fed's independence is damaged. So I thought that was interesting.
Yeah, I see that. Well above 4,000 by mid-2026 in the middle of your page, Mario. I see that.
Yeah, it's here. Yeah, right there.
Their calls just follow the market.
Yeah. The other couple of weeks ago, Bank of America, which is another bullion bank, they said, "Oh, we're bullish silver. We see silver at $42 by the end of 2026." And I thought, that's not bullish. We're almost at 42 now. So, the bullion banks, I mean, I've been following them since I started following gold in '02. And I mean, now they can't do it anymore because gold is in a massive bull market. But for example, a few years ago, if gold was like 1,500, they'd say, "Oh, in the next few years, we expect gold to revert back to 1,000," and like so on and so forth. But now, they're saying they're bullish, but I think they're not bullish enough. And one of the reasons is these couple of charts here, and I'm going to bring them up. First one is a bit more short term, and this line here, we're going to see in the longer term chart. I think it's really important. And it was around 2,700, this line. And that's why I think we saw this pullback, in the retest. And now as well, I mean, we've broken out of this pennant or symmetrical triangle, and it's really taken off. And there's nothing like above here. So that's very bullish. I'm not saying we won't see any corrections, and then this one is the same chart, but really long term. And this is why that 2,700, in my opinion, was so important. And I was waiting for that
Wait,
test.
Mario, can you flip back to the other one so I can see the
Yeah.
difference for a second? Okay, yeah, and then go to the forward. Okay, okay.
So this is from the high in 1980 to the high in 2011. That's where that 2,700, when we're breaking out here, I thought we might see resistance at 2,700. I mean, we didn't initially because it went up quite a bit, and then I'm not sure, it went 2,900 or something, and then it broke back down. I think it was after the Trump won the election. But now, I mean, we're really taking off, and a lot of people don't look at these long-term charts, and this is why I think yeah, people are concerned about a liquidity event.
Rafi Farber, known as the Endgame Investor, in an interview with Phil Lowe, Mario Ineco, and Clive Thompson, points out that China is injecting funds into its banking system through what it calls reverse repos, essentially providing liquidity much like Western repos. The government is trying to reflate its struggling economy, which faces weak exports to the US and a collapsing property market where apartments, once the main savings vehicle, are now oversupplied and losing value. This has left many Chinese households cautious about spending. While some argue China could rise as a global power, others believe its fate is tied to the West. If US consumers are broke, Chinese producers suffer too. On top of this, China holds vast US dollar reserves that may lose value, and even its large gold stockpile could backfire by pushing domestic prices higher and undermining exports. In short, both China and the West are trapped in the same fragile global system, and neither has outsmarted the other. Let's revert back to the...
This is the case. I think when China refers to reverse repo, they mean what we would mean by repo. I think they just got their terms.
Yeah, they are buying. I think they're buying the government bonds from the banking system and injecting cash into the banks. I
Yeah,
think
so
US is the other
that's what
way
we would
around.
call repo. In
Yeah,
China they
yeah,
call it reverse repo.
yeah,
Whatever. It means they're injecting cash into the banking
yeah,
system.
yeah.
I didn't hear about this. China they're like on a different wavelength because their interest rates are going down and down and down, and the West interest rates are going up and up and up. I still think that when the West falls, China falls with it because they are the producers and we are the consumers. So if the consumers fall, the producers fall too. Like if you lose your customers, you lose your income. Or if the currency collapses in which you're getting your income, then you lose your income also. Why China would be injecting cash now? I mean, we know. I mean, the place is very opaque. It's still communist, except for the special economic zones that they allow freedom in, so they can supply the West with a bunch of stuff so they can stack more dollars. But China's economy has been so fake for so long, and they still have these ghost towns and this whole real estate bubble throughout the whole country, and it's still like a very corrupt, disgusting regime. I mean, we're not allowed. We don't really say that because the West gets most of its stuff from China, but that's still the reality, and it's gonna have to go.
Not very different though from our regimes.
That's true. No, I guess in the way it functions, no, but at least, I mean, the West still has an idea of individual liberty, whereas I don't think the Chinese see that as a value at all, other than maybe a temporary expedient. There's still a feeling in the West that individual liberty is a good thing in and of itself. In China, that was never there.
Things, the Chinese injection of funds, or
I mean, they want to reflate the economy. China's suffering obviously from the slowdown in sales to America on the one hand, and secondly, the way of saving traditionally in China has been by buying apartments. So many Chinese people bought apartments, and now suddenly they're finding that the bottom's fallen out of the market because there's far more apartments or houses, if you like, than there are people to occupy it, and the population is not rising anymore. So and a lot of building companies have left these blocks of apartments which they're building and that people have paid for. They're half empty. So suddenly everybody is now drawing in their horns saying, oh my God, my traditional form of saving isn't working, and they're not willing to spend money on things. And so the Chinese government definitely has to reflate the economy. I think we're going to see more of that. I think that's just a first step, and we'll probably see more money thrown at the economy sooner or later.
Oh, yeah, there's a lot of people who think that China is somehow eating our lunch, that they've somehow outsmarted us, that, and I think your friend King Kong, Eric Young, is talking about the rest of the century is going to be the Chinese century where China's going to move to the forefront.
yeah,
I don't
Jim
think that's true
Rogers
at
said
all.
that too, didn't he? Jim Rogers, I think, yeah.
Yeah, I don't think that's true at all. I think we're going to see. I mean, we're all going to go down together. It's not like we're going to do fine and they're going to collapse. They are holding enormous amounts of American dollars. We took all their stuff and we gave them dollars, which we're going to default on, and so all the people holding dollars are going to be completely broke over there. Not to mention they have overbuilt their industry, and maybe some people say, well, it's better to be overbuilt than underbuilt, but they're going to have a bunch of factories with absolutely no one to sell to because we are broke. America's broke, so we can't buy any more Chinese stuff, and there's not going to be anything in China to sell. There's not going to be anyone to buy. They can maybe sell domestically to their gold holders, and gold and silver holders, but most of the Chinese are also broke because instead of going to gold, they bought a bunch of real estate. So to say that if you think the Communist Party of China is somehow doing better than us, then we should not have a free society. Then communism works, right? If you think communism works, if you think China's beating us, then that means communism works, and maybe we enjoy our personal liberties better, but communism is now a better state. And
well, I didn't say that. Yeah. I'm just.
I know you didn't. There are Chinese.
I'm
Chinese
just reporting on the injection of funds. But
yeah, absolutely.
I think China though has a lot more gold than they tell us publicly. They've got a lot more than 2.3 thousand tons.
That's also not that's not necessarily a good thing, because gold has, having lots of gold in a system. I'm not talking about a person, because people mistake what I'm trying to say. For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock, because we will want to sell them stuff to get their gold. Now, what's that going to do to Chinese industry? It's going to collapse it. Chinese export-based industry, when prices are sky high in China. So they have all kinds of problems on their end too. It's not like they are not outsmarting us. They're not outsmarting the system. The system is stealing from everybody around the entire world. And we Americans are sitting in drowning in debt. And in China, they're slaving away for American debt that's not worth anything. So they're slaving away for nothing.
Both the US and China face mounting economic pressures, whether it's America's debt-driven push toward hard assets like gold and silver or China's struggle to sustain growth amid a real estate bust and reliance on weakening US demand. Precious metals are increasingly seen as safe havens in this fragile global system, and their rising momentum underscores a deeper shift away from trust in paper assets. Could silver's potential designation as a strategic resource accelerate its price far beyond current projections? If China reveals its true gold reserves, would that stabilize its economy or trigger more volatility worldwide? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.